A very good day to all of you guys. Hope you guys are doing well. Welcome to yet another virtual session. This is actually our second session in the combined class series we are conducting as a part of our Econ-Hub program for the 2024 advanced level batch. So today we are going into the further areas and chapters of international trade. Unit 9, which is the first unit we have chosen to start off our combined class series. So we have had one session, the first session, in which we completed up to page 17 of your study material, where we went through the introduction and the theoretical underpinnings of international trade, the absolute advantage, comparative advantage, the calculations, the analysis, all that. Right. So now we are towards the end of the first chapter. So I just want to quickly read what is in the bottom of page 17 of your study material. And then, Puta, we will move into the final part, the limitations of the comparative advantage theory, and also what are the disadvantages or demerits of a country's decision to engage in international trade. Right. So with that, let me go to the study material and we'll get going. Right. I've shared the study material on your screen. Hopefully, I've shared the screen with you guys with the study material. Hopefully, you guys can see it. Am I right? Yeah. Right. Excellent. Thank you for the quick feedback. Right. So page 17, Puta, as you guys can see. So, right, page 17. Now, overall, this overall conclusion is connected with a country engaging in international trade based on comparative advantage. Okay, based on comparative advantage. So it says it is a more practical and logical approach towards evaluating of a country to evaluating the decision of a country. So practical, logical approach, right? So here it says it is, we are looking at the comparative advantage theory, right? Or theory of comparative advantage. And then through that theory, we talk about a principle of comparative advantage, right? So I think I used certain abbreviations, so let me stick to the same thing so that you guys don't get confused. The principle of comparative advantage was called PCA, principle of comparative advantage. So the theory of comparative advantage, the principle of comparative advantage are seen as very practical, logical ways for a country to evaluate their decision whether to engage or not in bilateral international trade. Bilateral meaning between two countries. Okay. Engage in international trade while effectively deriving. Now, the purpose of engaging in international trade is to attain a list of benefits, a range of benefits, right? Economic, strategic, socio, political benefits that we get by engaging in international trade. So, none more important than the two main economic benefits of international trade. That is the benefit of specialization or gains from specialization and the benefit or gains from exchange. If a country wants to enjoy the optimum economic benefits of international trade by engaging in bilateral international trade with another country, the decision to do so, what products to specialize, what products to specialize and export, what products to import, those decisions that country has to make based on comparative advantage, comparative cost advantage, or simply by looking at what are the products they could produce at the lowest opportunity cost. Second point says, accordingly, comparative advantage becomes an essential and adequate condition for mutually beneficial, both countries benefiting, international trade benefiting both countries. Now, when you read this, you have to then remind yourself, we said the theory of absolute advantage and then the principle of absolute advantage is neither essential nor is it adequate for a country to make a decision on engaging in international trade. But comparative advantage is number one. It is essential to have a comparative advantage. Number two, it is enough if you have a comparative advantage. When you have an absolute advantage, it is not enough. You go further and look at comparative advantage. Comparative advantage is it. If you have a comparative advantage, it's adequate to make a decision on international trade. If you do that, then you will be able to enjoy certain numerous benefits, range of benefits, mainly the economic benefits of specialization and exchange, benefits of specialization and exchange, right? Then this note, where it says noteworthy, this note, we have gone through once, right? I have given it again at the end of the discussion so that this point very, very strongly goes into your mind. Okay? I'm going to read the whole thing with you once and then we are going to move on. Ready? Right. When a country has an absolute advantage over the other, meaning trading partner country, in the production of all goods, now, the moment that we realize that according to absolute advantage, we do not have a basis for international trade. According to absolute advantage, if one country has the absolute advantage of all products, that country should produce all the products and the other country should not produce any good or service. So there is no mutually beneficial trade possible according to absolute advantage. But in practice, we say, just because we don't have a basis for international trade, based on absolute advantage, we do not need to give up on international trade. Why? Because absolute advantage is not a necessary nor adequate condition. What is the necessary and adequate condition? Comparative advantage. So go further and estimate the comparative cost, comparative opportunity cost within the country of producing the two goods. Then compare that opportunity cost of producing a given product with that of another country. You will see there is a comparative cost-based ability for you to engage in international trade. So it says the given country should only specialize in the production of goods they have more comparative advantage in. Now, they shouldn't produce all the goods with that. They should only produce the goods. Out of all the goods, they have an absolute advantage. They should pick and choose the goods that they have a higher comparative advantage and produce those. If there are 10 items on which they have an absolute advantage, the absolute advantage theory principle says produce all 10. Comparative advantage theory says no. Out of those 10 also, there might be certain goods, we'll say 5 items are there or 6 items are there that you have a lower opportunity cost of producing with another country. Then only produce those 6 and do not produce the other 4, even though you have an absolute advantage. Because the other 4 goods, 6 have a higher comparative advantage, meaning low opportunity cost. But the other 4, compared to the other country, trading partner country, has a higher opportunity cost, meaning a lesser comparative advantage. So don't produce those 4. Allow the other country, which has a comparative advantage on those goods, even though they have an absolute disadvantage, allow your trading partner country to produce those 4 goods. Now you have a basis for international trade. You produce 6 of the goods, they produce 4 of the goods, and you can engage in mutually benefiting international trade through which you can derive the benefits of specialization and exchange. Global output will increase and we can consume goods and services. Our consumption possibility, our bundle of goods we consume can be beyond our production possibilities frontier. Then it says, while the other country, the trading partner country, should produce goods on which they have a lesser comparative advantage, thereby both countries can. Now here they means, don't get confused, I want to be very clear. They mean in the country under consideration, right? A lesser comparative advantage, and thereby both countries can obtain mutual benefits through international trade. Okay, right. I want to finish this off once and for all. So if you guys have any questions, clarifications here, especially about this small para that we read, which I have extracted from or taken from your professor's text, right? Given the source, you can ask. If not, I think all of you got the basic idea of how this works, right? Okay. So what are the basic limitations of the comparative advantage theory? What are the limitations of the comparative advantage theory, right? Now, most of these limitations actually are based on the assumptions of the comparative advantage theory. So, if I may ask you guys to go to page 7 of the material. You guys have the hard copy of the study material. So, I'm going to say here. But if you go to page 7 of the study material, you will find in question 7, the bottom of the page. I think you found it, hopefully. The assumptions of the comparative advantage theory. I'm going to do a quick run through of the assumptions so that we understand the limitations. Right. There are two countries and two commodities. Right. Thank you. There are two countries and two commodities in this model. So it's a highly simplification here. Highly simplified model. Whereas in reality, there are hundreds of countries and there are thousands of millions of products, but we assume only two countries and two products. The assumptions I'm going through, okay? You don't, right, first. Then it says perfect mobility of labor resources. The homogeneous factors we assume, perfect mobility. And we assume every country has a fixed endowment of resources. So they can shift resources, substitute resources from one industry to another, from one product to another amongst the two products within the country without any problem. It's perfectly homogeneous. The resources are, which is not practical also because we know resources are non-homogeneous or job specific. Yes. And also a fixed endowment of resources. We can assume the endowment of resources is fixed, but in reality, certain resources or in general, it's very dynamic, very fluid. Things keep changing. Then it says fixed or constant opportunity cost. We know fixed opportunity cost, constant opportunity cost is a unrealistic situation. In the real world, it's always what is applicable? Increasing opportunity cost or the law of increasing marginal opportunity cost. And also we have assumed constant returns to scale. All of these are assumptions. Every assumption makes the model a bit weaker because especially when the assumption is different from the reality or what happens in the real world. Then it says full employment of resources, but sometimes we know there is unemployment unavoidably sometimes. And then it says two more assumptions we have made. Perfect competition, no trade barriers. In the real world, perfect competition is something we strive or want to have, but practically we find few markets that are perfectly competitive. We have highly competitive markets, and yes, in the real world, monopolistic situations are enough and more present. Also, trade barriers are there. Countries protect themselves by having import taxes and taxes and other kind of barriers on international trade. Finally, it says no transportation cost and externalities. Again, not very practical because in the real world, transportation cost is a big part of international trade. Isn't it? Logistics is a big part of international trade. Also, when we engage in different economic activities, there is very much the possibility of externalities, both positive as well as negative. Right. On keeping those assumptions in mind, let's quickly go through the limitations. The first limitation argues that this is a highly simplified and less realistic model. Why? We only take two products and two countries. Okay. Second limitation is there will not be perfect mobility of resources, which is also true. in the real world, resources are not perfectly interchangeable. They are not perfectly interchangeable. So they are not homogeneous, and they tend to be non-homogeneous in reality, right? So two limitations, very easily we can understand, again, connected with the assumptions. Thirdly, subsequently, now that is based on the first two limitations we have established, we have proven. Subsequently, the fixed opportunity cost. No, fixed opportunity cost is not realistic. It's not a realistic situation. In reality, realistically, what happens? There is always increasing opportunity cost behavior. But if opportunity cost keeps changing, the comparative advantages change from country to country. It keeps shifting from one country to another. So to make our analysis easy, we estimate opportunity cost and we assume that remains fixed so that we can compare. Right. So then we look at the next limitation, drawback or demerit of the comparative advantage theory. The assumption of constant returns to scale and full employment of resources is unrealistic, as I explained. So again, we keep on hitting the assumptions and coming up with limitations or identifying them as limitations. Then the assumption of, okay, assumption of no transportation cost is unrealistic. As I said before, the logistics is a big part of. Significant impact is there on the comparative cost because of the transportation or logistical cost. Then next, many production and consumption activities create externalities, both positive and negative. So assuming externalities do not exist is also an impracticality of the comparative advantage theory. The existence of barriers, different barriers are there, trade, tariff and non-tariff. No, those are due to political reasons we have barriers, social, strategic reasons. So assuming barriers don't exist for international trade is impractical. Finally, modern economies and trade dynamics and comparative cost theory is now modern economies and trade are dynamic, but the comparative cost theory is static because we make so much assumptions holding things constant. It's a static model, but the economy is dynamic. So there's a conflict there. That's a limitation. That's a limitation. Right. So these are standard examiner accepted and expected limitations. So make sure you guys are smart to go through the assumptions and the limitations together so that you don't need to put double the effort to remember the assumptions and the limitations. It's just a way of writing. That's all. Okay. Right. If there's anything to clarify, please do ask. Then we come to the final part of the first chapter. Outline the limitations or drawbacks. What's another way to say it, Putta? The demerits of international trade, free trade, international specialization, or we can say having an open economic model. Okay. So I'm going to quickly highlight the key points here. I have described most of them in somewhat detail, and we will go through some of these points again when we do protectionism also. Okay, right. So let me put the foundation and then build the wall, build the structure in protectionism. Domestic market-based producers. So basically, there is a big impact on domestic producers when there is international brands coming into the country with a country engaging in international trade. Get discouraged, and sometimes in Sri Lanka this has happened enough and more over the last 45 years since we have been a open economy. There are numerous industries, not one or two businesses, but the industries themselves have collapsed in our country. So that's a big problem. Now, this is what later on we come up with as an infant industry argument also. We'll talk about that in protectionism. Right. Then, okay, high level of economic dependence. That's a major issue that we face. So economic dependency can be explained in different ways. But more than anything, if our imports are very inelastic, if we depend on certain essential commodities, energy and things like the petroleum products, food items, medicine, things like that, machinery, equipment, if we are heavily dependent on imports, if we are inelastic with those, that puts our economy into a major risk, especially with sometimes with the small changes in the world market price of these goods. We have cost push inflation, imported inflation in our country, or when our currency starts getting weaker against the foreign currencies, when the rupee, for example, depreciates against the US dollar, like what happened in 2022 and the first part of 23. When the rupee starts to strongly depreciate, what will happen? The amount of rupees we need to buy dollars increases. Everything we import, even though their world market price hasn't increased, our rupee cost keeps sharply increasing, and that leads to a inflationary pressure. This is because one of the reasons why we can't control that is our heavy dependency, economic dependency on international trade and especially imports. Okay. Then the disadvantages of dumping, I would like to explain this prohibited, unethical international trade practice called dumping. When we do protectionism, I have a special note for you there also on dumping. But for now, the basic idea is when countries sell goods at a very, very low price, sometimes at a price below the cost of production, that leads to a major exploitation of the importing countries, consumers, and it has a big impact on the importing countries, domestic producers as well. Then highly volatile. You guys understand the word, right? Volatile, unpredictable, a lot of fluctuations. Volatile nature of exports. See, the demand we get for our exports is very undependable, very volatile, keeps changing. Sometimes with a small increase in our prices of exports, we could lose the entire market or a demand for that product. So when that happens, again, it comes back to that economic dependency also. If a big part of our GDP, if a big part of our economy runs on export-oriented industries, depending on the world market, that also has an impact when there is a volatility in the export markets, right? So economic dependency, this inelasticness we have of imports, and the volatility of exports is a major limitation problem we face when it comes to international trade. Misuse of natural resources or exploitation of natural resources could happen, especially by multinational corporations, Yes, there's a question. Dumping means trade malpractices, right? Kind of. WTO, World Trade Organization, has a very strong policy against dumping, but it is not illegal, Buddha, in most countries, because in most countries there are no anti-dumping laws still, but it is definitely a very unfair, unethical international trade practice, which is discouraged and very much against the WTO fair trade policies, World Trade Organization fair trade code of conduct or policies. Is that clear? Then it says high dependence on foreign investments. Now, again, case in point, Sri Lanka. Because we can't really generate enough funds for domestic funds for investment in our country, within the country, and since we can't borrow and invest also because we are already in a country in default, right? We don't have any credit worthiness to borrow. So therefore, what happens is we are heavily dependent on foreign investments. But with investments, it's not only funds, it's not only technology, it's not only employment opportunities, it is not only modern management methods that come into a country. Also, there's a lot of influence that these investment companies that invest can do. They can influence politicians. They can sometimes influence our policies. So that has an impact. Then excessive foreign debt burden that Sri Lanka has, given an example to many developing countries in the world, how not to get sick on or addicted to debt, foreign debt especially, and how that could lead a country into a debt trap, and that could lead a country into a massive financial and economic turmoil. Then possible cultural, social issues. Then political dependence could be there. The influence of major economies that help that get involved with us in international trade. Threat to it could be a threat to our national security as well. No, we talk about this Indianization and the Chinese influence and all these things, right? So overall, these are seen as some of the major limitations of international trade and arguments against international trade. So it's a balanced scorecard approach that we have to take. We have to put now we started this chapter with the benefits of international trade. In page number 3, you will find I have listed the benefits of international trade in page 3. Then in page 18, I'm listing the limitations of international trade. So you put these to the scale, you balance them out, and then you make a decision on engaging in international trade, opening up your economy, and what areas do you open up? How do you engage with the rest of the world? These are conscious, strategic, long-term oriented decisions countries have to make, and not overnight decisions, spontaneous decisions that need to be made on certain emotions or political impulses, which is unfortunately the case in our country. So we haven't been very strategic about how we engage with the rest of the world. So we have not developed certain strong international trade base in our country. And 45 years after 45 years after becoming an open economy, we haven't still got the best benefits of international trade. Got it? Right. Any questions? If not, ladies and gentlemen, we are done with the first chapter of Unit 9, which is Introduction to International Trade, theoretical underpinning, absolute comparative advantages, the related analysis, estimations, all that. Then economic benefits of international trade, benefits of specialization, benefits of exchange. Then in conclusion, looking at what theory works best in terms of absolute comparative. And there we concluded comparative advantage, absolute advantage is not a necessary nor adequate condition, while comparative advantage is a necessary and adequate condition for mutually beneficial international trade. And then the part we did just now, limitations of the comparative advantage theory or theory of comparative advantage, and the limitations, the cons of international trade. Okay, right. With that, we go to the second chapter, which is essentially terms of trade. So I'm giving a small introduction here to what is terms of trade in page 19, right? In page 19. So this is a small part for that, but a bit important, especially in the MCQ paper. And in the second paper also, there can be some distinguished questions, the conceptual differences kind of things. Right. So page 19, there's always possibility of questions in both papers. Okay. So you have to prepare accordingly. Right. Question 10. What is meant by terms of trade? Specifically, commodity terms of trade. There are 2 terms of trade concepts in your syllabus that we have to learn. Commodity terms of trade and income terms of trade. So if I just explain that thing first, that distinction first. But we use the word terms we use the phrase terms of trade in a very common way, broad way. Terms of trade in A levels, that's how we do it, right? From advanced level, POV, okay? We look at the word terms of trade very broadly, and it will include, right? It is supposed, no, sorry. That shouldn't be written there. Okay, let me finish this first. Terms of trade broadly is of two forms. There are many other forms, but mainly we look at two things. One is commodity, TOT, terms of trade. The other is, we'll call it for now, income, import feasibility, income terms of trade. So both are terms of trade concepts. In local A levels, in A levels, when someone says terms of trade, right? When someone says terms of trade, GWS. What is GWS? Anyone who remembers this? We used it, I think, mostly in Unit 5, special theory classes. GWS is what? It is not an organization or anything, okay? It's just a term I'm using. Acronym I'm using. The letters stand for some words. Brilliant. There we go. Goes without saying. So in A levels, okay, I'm writing with the red color marker or the pen. A level point of view, terms of trade goes without saying. I'll use the light also. Okay, when you see terms of trade in the paper, you have to understand, we are talking about commodity terms of trade. In A levels, terms of trade is commodity terms of trade. But terms of trade in general is a broad word that includes commodity terms of trade and income terms of trade. Most teachers get a bit confused there. Okay, right. But in A levels, when you see in the paper terms of trade, they are talking about GWS, commodity terms of trade. Right. Any questions you guys can ask? Okay. Right. Let's get the concept done first. This is the principal determinant, or this is what decides the benefits a country could receive from international trade. It's very logical, but the terms of trade, more than anything, is nothing more than, sorry, terms of trade, okay, all the phrases I've used. I'll pause for a few seconds to answer this. There's a question asked by one of combined classmates. Sir, this is not available. How can I get it? Puta, you are a physical student, physical class student of mine, or a virtual student? I'd mention your name, but student who asked the question can quickly respond. Okay, virtual, right? Then Buddha, get in touch with the coordinator, right? And I think from yesterday was the 1st of May. We have made the payment links and everything available for the combined class. So do that part, that administration part, and then get in touch with the coordinator. Buddha, you should be able to get the tube couriered. Until such time, I've given a part of the study material as a PDF, but unfortunately, the entire study material for intellectual property reasons, I can't make it available as a PDF, but you can get the hard copy definitely. Okay, right. So with that, let's move on. As I was saying, how much of benefits or to what extent a country could benefit from engaging in international trade with its trading partner countries will be determined by the terms on which it engages in international trade, i.e. terms of trade. The basic concept of terms of trade, it's nothing more than when we export something to another country or to the rest of the world, when we export one unit of a product, or when we export from that export, whatever we earn for that unit that we export or for the total income we get from exports. Are you guys with me? Just bring your concentration fully into this. Okay, right. Now, let's get the basic idea. I said the concept first. Right. So what is terms of trade? Terms of trade is nothing more than when we export something to the rest of the world, we'll say one unit of a product when we export to the rest of the world, the price we get for that unit, or everything we export to the rest of the world, the income we get from that exports. It can be the unit, the price we get for one unit, or it could be the total income we get from exporting. It doesn't matter. But when we take what we get by exporting to the rest of the world, how much goods can we import from the rest of the world? That is what terms of trade is. So if terms of trade is appreciating or favorable, that means we are benefiting more from international trade with them. Because what we earn from the world, we can import more goods from the world from, listen carefully, we can import if a country's terms of trade is improving, if a country's terms of trade is appreciating, what that means is that country can afford to, or that country is able to import more from the rest of the world from the income it earned from the price it got for its exports from the rest of the world. That is the concept. Got it? Right. So I now want to come to this second point. It says, an indicator of the number of imports, how much imports, commodities that could be obtained or purchased. Remember, we are explaining commodity, okay? We are explaining commodity terms of trade. While the general concept of terms of trade is also there, right? Could be obtained from or purchased from one unit of exports. From one, sorry, from one unit of exports. This is the idea of commodity terms of trade. Commodity terms of trade. Simply in one line, how do we say? In one line, this is with the import purchasing power of an export unit. So this is a really good definition for commodity terms of trade. Commodity terms of trade. Is that clear? Right. So that's clear. Then alternatively, how much of one product must be exported in order to obtain a unit of imported good? But that second point really hits the nail on its head. Commodity terms of trade. Right. Then it says terms of trade is an important index. So when you're given terms of trade is 120, 110, 75 or 80 or whatever, it's not a money value. It's an index number. What number? Index number. Right? It is based on the import and export price indexes. It is calculated using import-export price indexes. Sometimes you guys need to keep in mind that alternative terms are there. Sometimes we call this a net barter or merchandise terms of trade. Net barter or merchandise terms of trade. Barter meaning because it's about goods. Get it? Right. So this is the concept of terms of trade. The concept of what? The terms of trade. Right. Especially we are focusing on first commodity terms of trade. Then we'll talk about income terms of trade. Right. In the space given there, we are going to write a few details that are important for us to know. First of all, we are going to talk about the input, right? When we estimate TOT, right? Yeah, let me write it properly. Inputs, commodity, TOT, index. We don't have to keep saying index. It's understood it is an index, but I just want to mention it, right? So what is the input to prepare the commodity terms of trade index? We need two things mainly. Number one, now I'm going to write this very clearly so that you don't get confused. You guys need to concentrate and get it done, okay? Number one, we need to put the export, okay? Price, sometimes called the export unit value. Value of 1 unit, listen, value of 1 unit of any product is the price of that unit. I'll repeat. Really listen this time and see whether you get the point. Value of 1 unit of any product is the price of that product. Yes or no? If I ask you for, if there's a dozen of Milo packs are there, right? Okay. At a value of, 1,400, right? Or whatever, total value. If I ask you, what is the value of 1 unit, 1 pack of Milo? What are you giving me? If I ask you, there are 12 packets of Milo, you give me the total value of the 12 packs. I ask you, what is the unit value? One pack of Milo, what is the value? The answer you're giving me is what, Puta? The answer you are giving me is the what? Price. Are you guys with me or not? Did I lose you? Quickly, Puta. Your time. Respond quickly. Are you clear or not on what I'm saying? Unit value is the price. That's the point. Are we clear? Right. So the Central Bank of Sri Lanka sometimes doesn't call this the export price. They call it the export unit value. What they are saying is the price. So export price or unit value index. Export price or unit value index. We normally use the abbreviation PX within brackets. PX. Export price or unit value index. Okay. One more thing to know here. The export price or unit value index has a base year, which is 2010. What is the base year we use? 2010 equals 100. Anyone, if you can just raise your hand and give me an indication, has the 2022 Central Bank annual report, the hard copy with you? Somewhere close by, accessible? Anyone? Out of all the students who are participating for the live session, is there anyone who has the 2022 Central Bank annual report? I don't have the hard copy here to show you. Anyone who has it? Where you can quickly get it? You guys realize that is the financial year for you, right? Right? No, it's okay if you don't have the hard copy. I'm asking, by any chance anyone has it? I'm sure your school teachers, have encouraged you to buy. Let's see. Okay, right. Not the hard copy, but the soft copy, right? Okay. We'll do this, but I will write this. Then we'll check for something. Yeah, right. Good to know. Just I was checking. Right. Number 2. Okay. What do we say then? Import price. What is price called? The unit value. So we have to say it properly, okay? We don't call it export price unit value. We either say export price or what value? Unit value. Import price or import unit value. Index. Which is PM. Why I'm stressing on this unit value thing and trying to make it clear is there's another index called Puta export value index, import value index. Don't get that confused with this. This is unit value. Actually, the word I should highlight also is unit. Unit value. Unit value kiyanne price. Okay? Right. So here also 2010 is the base year and the base year value is 100. 2010 equals 100. Okay, right. So we'll quickly check these two, the validity of them, and then we'll finish the formula. Okay, or come to the formula. Okay. So by now, you guys should be able to see the central bank annual report. Am I correct? Yeah, central bank annual report. Can you see 2022? Okay, yes or no? Full screen? Yeah, good. Now this is the soft copy, the drop down is there. So I'm going to go for the, as you can see, key economic indicators. Okay, we're going to look at the key economic indicators. Right. Is this not moving? Key economic indicators. Okay. Right. If I click on or tap on whatever on key economic indicators, I go to this table with a lot of data. We have to scroll down a bit. Okay. Then you will see external trade. I'll zoom in a bit more. You guys will see what trade? External trade. Yes or no? Right. This part, external trade. Can you see export unit value index? Central bank doesn't call it the export price index. They like to call it the export unit value index. What is the base here? Export unit value index. Export import unit value index. Can you guys see the highlighted parts? Right? Right. That's how they refer to it. What is the base year? 2010 equals 100. Okay. So that's the updated base year. Right. Good for you. So that's that. Then coming back. Okay. Let's look at the formula. So since I have indicated that the export-import price indexes are abbreviated with PX and PM, I'll use them. But if you can, I would appreciate it if you write the full thing also, but that's up to you. Right. So but the commodity, okay, TOT, terms of trade equals export price index divided by import price index multiplied with more than saying 100, learn to say base year. Base year index value. That is what the 100 is. Okay? Right. Write this and know the basic formula. The formula is also very logical. We are looking at, now, for example, if I export, right, I'll give it in a simple way. If I export some item Buddha, and if I get 1,000 rupees, if I get 1,000 rupees, and with this 1,000 rupees, I am trying to import an item, okay, worth 250 rupees. I'm trying to import an item from the world market worth 250 rupees. I'll keep it rupees. How much did I get from exports? 1,000. I'm trying to import something worth 250. How many units can I import? What is my import ability of my export earning? Export price or income I got, earning that I got. What is my import ability in units? In barter terms, real terms, how much can I import? If I have 1,000 with me, if one unit that I'm trying to import is 250, how much can I import? My God, I was expecting a flurry of answers instantly. I have 1,000 rupees with me, but I'm trying to import something. 1 minute is worth 250. Price is 250. How many units can I import? The delay is looking bad on you. It's hurting your image. How much can I import? How many units? Ah, very good. 4 units. How do I get the answer for? How did I get the answer for 1000 divided by 250? What is the 1000? What I got for export? What is the 250? The price of import. So export divided by import. I'm simplifying it. Export divided by import. That's the logic. But we do it index numbers. So export price index divided by import price index into 100. Special note. I said sometimes this distinguishing theoretical questions are there. So I want you to be clear on this. Okay, very quickly. 3 things has the possibility of getting mixed up. 3 concepts because they deal with similar variables, sometimes sound the same, they can get mixed up. They are conceptually different things. First, trade balance, terms of trade, foreign exchange rate. 3 different things. Trade balance is the difference between, trade balance is the difference. Okay, I know you guys absolutely don't care about these color separations, but just for my satisfaction, difference between merchandise, visible goods, exports and imports, right? Visible goods, exports and imports. I would like to add something, my intelligent students. No, we don't need a comma, right? Exports, imports. I would like to add values. Export, import, values. Can you write values there? Right. So that's basically trade balance. Export value minus the import value. Now, don't get this mixed up also with net exports. Because there's a slight difference between net exports and trade balance. Because trade balance only take goods put up. Net exports would take and services. That's why, right? Trade balance is that. Simply the difference between the export value minus the import value. Export income minus import expenditure for a period of goods, tangible or visible goods. That's called trade balance. Done. So it's a balance, by the way. Okay, it's a balance. That's also important. It's not an index. It's a money value. Okay, and it could be a surplus or a deficit. So it's a, I'll write it here, money value, and the outcome could be, outcome is either a surplus or a deficit. In Sri Lanka, it's right. Okay. Done? Right. Next. Terms of trade. Now we talked about, it's very clear to us. Terms of trade is a no-brainer for us, right? Terms of trade is the relative price of exports and imports, whereas the balance of trade is based on value. But here it's based on basically a relative price comparison. Another thing we can write here is based on the relative prices of exports and imports. Now, 2 things you should see. Price of exports. We can say, sorry, I'll write it here. Now, we can say it is an index. No? Terms of trade is an index. Here it's a balance. Terms of trade is an index. No? So in an index, you don't say surplus deficit. You say appreciation, depreciation, increase, decrease. That's it. Index. Do you see this difference? Price and value difference. Because value, I'll write it here, value is basically price into quantity. Okay? Price into quantity. Trade balance takes value. TOT only takes price. So the difference between, or I'll say, the delta or the difference between the two is the quantity. One takes the price, other takes the value. Value is price into quantity. Are we clear? So these small differences, conceptual, technical differences, they expect you to know in the exam. Okay, done. Any questions you guys can ask? Are value and unit value the same? No, Buddha. Can't be. Value is price into quantity. Unit value is another word for what? You have it in your tune. I'm sure I've written. Unit value means price. Value means price into quantity. I think I'm very clear there. Right. Exchange rate. Foreign exchange rate. Now, how foreign exchange rate comes into this discussion is, you might wonder that. Because foreign exchange rate, when we decide the exchange rate based on a floating system, flexible system like we do in Sri Lanka, it's based on imports, exports of foreign currency. Import, exports of foreign currency is mainly about, it's based on, what did I just say? If you decide the foreign exchange rate based on floating exchange rate system or a flexible exchange rate system, same thing, more or less, then you're deciding the exchange rate like you decide the price of a good or service in a free and competitive market. That is based on demand and supply. That is what I should have said earlier. Demand and supply for foreign currency. Demand and supply for the currency. Now, demand for currency, supply for currency is directly connected with imports and exports. So that's how foreign exchange rates comes into the discussion where we are talking about imports and exports. Okay. So I've explained what is a foreign exchange rate. Especially we talk about nominal exchange rate. We'll learn this unit 10. Okay. Unit 10, the third chapter we can say is mainly about foreign exchange rates. Refers to the price. So again, foreign exchange rate is the price of a nation's currency, domestic currency. Now in Sri Lanka, the price of the rupee in terms of another currency. That's what the exchange rate is, no? Value of the Sri Lankan rupee in terms of US dollar. We call it the bilateral nominal exchange rate between the rupee and the dollar. The price of the Sri Lankan rupee in sterling pounds. The bilateral nominal exchange rate between the rupee and the sterling. Likewise. So exchange rate is the price of the domestic currency in terms of another currency, foreign currency. Right? You can give the exchange rate in different ways. Right? Directly, that is when you say how many LKR you pay for $1 example, right? 1 USD equals how many LKR? That's called direct method. The indirect quotation means 1 LKR. Okay, you obviously see the difference, I'm sure. 1 LKR equals how many US dollars? How many US dollars? So there are two ways to give a country's exchange rate. That's a concept. Then it says in a direct quotation price unit, that is that indirect quotation, fine. The exchange rate, remember, is decided based on the demand and supply. That is what is influenced by imports and exports. And obviously, when we import export, because we deal with other countries with their currencies, we'll have to go through our foreign exchange rate. You can't talk about international trade without the foreign exchange rate. Three concepts, just be clear on the basic idea. Right. Then we come to a very simple area. Okay. how do we talk about, or what would lead to what are the reasons for an appreciation and a depreciation of our commodity terms of trade? To easily understand this, right? So these are the reasons. The basis to identify the reasons is the terms of trade. Remember, in local advanced levels, when we say terms of trade, what does it mean? In local A levels, when we say terms of trade, it means commodity, GWS, commodity terms of trade, right? What is the formula? All of you should remember the formula now. Try to, yes? Is anyone trying to?
මේ අර group එකෙන් දානවා ඉඳලා හිටලා lecturers ලාගේ ඉක්මන class.
Right. Harindi, Puta, your mic needs to be muted. Right. Okay. So as I was saying, what is the formula? Terms of trade is, okay, terms of trade is export price index divided by import price index multiplied by 100. Basic mathematical logic tells us whenever the denominator value increases, the answer increases. Whenever the denominator value decreases, the answer decreases. Generally, right? Sorry. I want to talk about the numerator. I said numerator or denominator. Anyway, doesn't matter. Let's talk here. What is this called in the formula? The top part. What is it called? Top part. No, don't say the export price index. Mathematically, it's called the numerator. Am I correct? If I'm wrong, correct me. Numerator, right. The numerator component, when it increases, the answer increases. So the numerator has a positive relationship with the outcome, answer. Yes or no? Numerator increases, answer increases. Numerator decreases, answer decreases. Right. When you analyze separately. Then what is this called? The lower component, what is it called? It's called the denominator. What is the relationship? Negative. No? When the denominator increases, the answer decreases. When the denominator decreases, the answer increases. Got it? So just that basic mathematical logic is what you have to apply with them. Very simple. Now look at this. Appreciation. Answer has to increase. Export price, obviously. So simple. Has to increase. Numerator has to increase. While import price remains unchanged. Right? Import prices unchanged. Import price, denominator, negative relationship. We want the answer to increase, decrease. Okay? So generally you can say export increase, import decrease. Nang hari. Increase will happen. Appreciation will happen. Or both can happen at the same time. That's also possible. Export prices increase, whereas import prices decrease. Still works. Those are the standards. Very standard situations are there. Then the exceptions are. Now, when you read the first part, you have to pick this, okay? Export prices increase. If export prices increase, sorry, export prices decrease. Problem, no. If you want the terms of trade, if you want the terms of trade to increase, but the exports have to increase. Numerator, no. Exports have to increase, but export prices have what? Decreased. But import prices are decreasing at a what rate? Higher percentage. Then it works because exports decreasing is going to reduce the terms of trade. But if import decreases more than exports, still terms of trade will increase. That's how easiest way to remember and start these points. 4 and 5. Okay. 5. Import prices increase. No problem. When import prices increase, terms of trade will decrease. We are looking to show an increase in terms of trade, but what will increase more? Export prices increase at a higher percentage. Are we clear? Any confusion? 5 situations easily you can come up with this simple understanding. The key is the formula, base is the formula. Export prices increase, then we say imports constant. Import prices decrease, exports constant. Exports and imports change at the same time. Exports increase, import decrease. Done. 3 situations. Then we go for the paradox and come back. If that is confusing, export prices decrease. Problem. Then we say no, but import prices decrease more. Then we say import prices increase. Problem. But export prices increase more. Done. 5. Deterioration. Deterioration. Can we come up with the 5 situations? Yes or no? I'm not going to ask you to do it now, but I'm asking you, can you write them? Yes or no? Quickly, Buddha, I need an answer from all of you. Can you write them on your own? I am 100% sure you can write them on your own. Just quickly check 4 and 5. Can you write for deterioration? No, don't write. I'm asking. Can you? Yes or no? How do you start? Number 4. On the deterioration or the decrease side, you say export prices increase, but import prices increase more. Then number 5, import prices decrease, but export prices decrease more. Get it? Right. You can figure this out. So I'm going to leave you to do that. And we are going to look at question 11. State. That's why they are not being elaborated. Okay. State the main economic consequences. Economic consequences, not only the negative things, right? Okay, but at the balance of an appreciation increase, not only the negative or positive. If there are any, if most of the points are negative but some positives, write the positives also. Most of the points are positive, some negatives, write the negative points also. Consequences is a broad way to ask. And a depreciation, which is known as a deterioration. That's another word they use a lot of a country's terms of trade. In local levels, terms of trade, GWS, commodity terms of trade. Right. First, I'm starting with the economic effects. Okay, that's another way to say of appreciation, commodity terms of trade. Right. I've given a list of points. Everything is logical, right? But before we start, one thing to keep in mind is, what is this all about? Before we start, one thing to keep in mind is, this area is about, or terms, commodity terms of trade is about export-import prices. They're not values. They are only looking at export price and import price and an index. Is that clear? Keep that in mind. Right. With that, here we go. Possible increase in export revenue. Why? Or earnings. Why use the word possible? Why can't we just say increase? Because for the revenue or earning is value judgment, values. Value is price into quantity. Import price index, export price index is only about price. So yes, if export prices increase, import prices decrease. Now, if export prices increase, we can reasonably expect our export revenue to increase. But 100% we can't say, because the export revenue or export earning or income depends not only on the export price, also the quantity. If prices increase but quantities decrease based on law of demand, if prices increase, if quantities decrease in a much bigger way, even though our export prices have increased, our export earnings may not increase. So we are being cautious and saying possible increase. Any questions? Quickly. If the idea went into your mind with the first point, Rest can be done quickly. Done? Right. Remember, commodity terms of trade. Terms of trade is about prices. So not values. They can only explain halfway. Right. Okay. Possible improvements in foreign exchange rate. Possible improvement in foreign exchange rate. And also the country's what reserves, foreign reserves or assets. When the foreign exchange rate improves, that could lead to that improvement, as well as if export revenue is increasing, that means more foreign currency is coming into the country. Again, the word possible is used because when export-import prices change, that has an impact on the export demand and import demand, which means the demand for foreign currency will also change. So if terms of trade has improved, that has a favorable impact because we get more for our exports, higher price for our exports, and we pay less for our imports. That's the general meaning of improvement in terms of trade. Remember, exports increase, export prices increase, import prices decrease. That's what we realized in the previous area. Okay, right. Please stop and ask if you don't understand something that I'm explaining. Okay, right. Next point. Enhancing the rate of economic growth. If we have more foreign currency coming in, if the exchange rate is improving and stable, right? Overall, okay, overall, whatever we import becomes cheaper. We can import more machinery, equipments, the intermediary inputs that we need, and our production can be strengthened and we can produce more goods and services. Economic growth is about producing more goods and services. So it has a potential to enhance our rate of economic growth because we are getting more benefits from international trade. Next, possible improvement, favorable impact on the trade balance also. Again, the word possible is there. Improvements on the trade balance. Why? Trade balance is a value judgment. It talks about export value, import value. But if export price increases, export value could increase. If import price decreases, import value could decrease. An increase in export, a possible increase in export value and a possible decrease in import value will be a favorable thing on the trade balance. Favorable on the trade balance. So if we have economic growth, if we can import things cheaper, right? If our cost of living or inflation rates are also favorably affected with all this, then our standard of living may also be enhanced. Enhanced because why? We can afford to buy more goods and services, and our basic needs and our other needs will be satisfied at a higher level, right? Which means our living standards will improve, right? Then reduced vulnerability, external vulnerability, because yes, when we engage in international trade, we do depend on we do depend on imported goods and things like that. But if we can maintain a good terms of trade or improve our terms of trade, that means the benefits we get from international trade are more than the cost on international trade. So that vulnerability, that negative, possible negative impact that could come from international trade, we have managed to reduce it, right? So reduce external vulnerability, right? Are we okay? Right. Then positive, please ask, okay, if there's anything confusing. Positive favorable impact on government or national budget. True enough, Nupata. Why? Because when the economy is stable, when the economy is growing, right? When we are benefiting more from international trade, that will lead to government's budget and the entire public finances being strengthened, because as an economy expands and as we benefit more from international trade, government's revenue will increase, tax revenue and government's revenue, because when GDP or economic growth is there, our national income is increasing. When national income increases, the taxes, income, the revenue of the government increases. On the other hand, when more and more people are able to improve their living standards, if people are coming out of poverty, their dependence on the government welfare will reduce. So government's welfare bill or expenditure reduces, government's income increases. So the budget is favorably affected, right? Then improved foreign, right? So favorable impact on the budget. Improved foreign direct investments. Foreign direct investors, so that is again leading to economic development, improvement in living standard and all that. Most foreign direct investors would like to go into a country that is having a stable exchange rate, stable economic growth rate, stable inflation rate, and which is having good terms in their international trade. So that will be a very attractive thing for a foreign company to come into a country and invest. Okay. Then opportunity to enhance economic diversification. Right? Economic, some people say diversification. Economic diversification is with the, now Sri Lanka has a problem with a lack of or limited economic diversification. We still, if you take our exports, we mainly depend on garments and a few other products. Imports, we have inelastic imports. So if you talk about exports, I mean, and if you engage in international trade favorably, and if you are doing well with your exports and getting a good price for your exports, right, you will go into more and more industries. The domestic economy will expand, new industries, new economic activities will spring up. At the same time, you will engage in more export-oriented production and go into new markets and new products, new industries. So then your economy doesn't need to depend on a few industries. And if one of those industries collapse, that leads to a problem. I may say this analogy or example multiple times in the future. So please do bear with me. What is the best way to explain the concept of diversity? In Unit 4, somewhere I remember I have explained this to you guys. There's a very classic analogy we used to explain, kind of an example we can say. We used to explain the meaning of diversity or diversification. What is that? Have you heard of the saying, or I'm sure you've heard of it being said by me in your physical classes or virtual, when we did Unit 4 somewhere, I explained this, I remember. Don't put all your eggs in the same basket. That is the concept. If you put all the eggs in the same basket, and if that one basket falls, all your eggs will break. Then no eggs. So what is the smart thing to do? If you have 10 eggs, yes, put 3 in one, 2 in another, yes, another 2, another 4 in another, and 1 in another, divide it. Assess your investments, assess the pros and cons, do a good investment appraisal, and then invest accordingly, but don't put everything in the same thing. Because then what happens is, then if one basket falls, you don't lose all your eggs. You're stable. So the point of economic diversity or diversity is for stability. It's for what? Stability. Right. So that is encouraged with favorable improved terms of trade, because a country is having good terms or benefits through international trade, they will be encouraged to expand their economic activities and the export sector. Possible reduction in inflationary pressure. I think I already spoke about it, right? Especially imported inflation is lesser because terms of trade improving means export prices increase, import prices decrease. Enhanced economic stability. So I think that is an overall point more than anything. With good economic growth, stable exchange rates, strong stable exchange rates, then less external vulnerabilities are there. Government budget is stable. No? So all things considered, we are overall macroeconomic stability is there. Economic stability is there. Right. And then finally, it says, right, this is a more technical point. That's why it's given a bit separately. It's not with the practical outcomes. Increase in the importing ability or feasibility of an expert. There's nothing called an expert unit. Export unit. Yeah, things happen. Right. Export unit. In turn, rise in real national income. Real national income basically means the national income or the output a country can achieve within the country plus what it can import from rest of the world. So our importing ability depends on how much we can earn through our exports. No? So the concept of international trade is the identify your competitive advantages, practice international specialization, generate excess output, export that excess output, import the goods you can't, practice specialization or you don't have a competitive advantage using your exports, using your export income, the price you get for exports. That's a concept. So real national income, don't overthink. Real national income is a simple concept that tries to talk about what a country can produce by itself within the country, that is basically the GDP, and then the primary incomes it can earn net NPI, ROW. So that is called real national income. Of course, the word real means it's adjusted for inflation, right? So now we have the real national income of a country, gross national income of a country. But all this is without the impact or without the ability of, without showing how much goods and services that country can import using its exports. So that we adjust separately. That's called the impact of terms of trade, the impact of terms of trade on the real national income. So that part we adjust and then we come up with a finalized concept called real GNI, real GNI or sorry, real national income. Okay, real national income. I've given a formula. You guys have learned this part, okay? This part is not new. How do you get to this part? Real GNI, basically, you take the nominal GNI, right? Nominal GNI is basically C plus I plus G, okay, plus NX. What is this? This is GDP. Remember, unit 5, GDP. Then to this, we add NPI ROW. Okay, this is called nominal GNI. You take this value, divide with the implicit price index, multiply with the base year, then you get, right? This converts into real GNI. Okay, that's how you get to real GNI. Are we clear? If you don't understand, please ask. Real GNI. Now we have real GNI. After you get real GNI, what you do is you adjust, you do a small adjustment. What is the adjustment? X divided by PM. X divided by PM, this part. What does X divided by PM mean here? X divided by PM means purchasing power of exports. So what is X? Export value. If you want to make a note, totally okay. Capital X here is export value. Sorry, export value. Okay, value. Then what is PM? Import price index or import prices will say below for now. It's actually import price index, import price. Okay, import price. Right? By doing this, what are you doing? You're calculating the purchasing power of exports. Another way to say that is impact of terms of trade, which is positively related with the real national income. Come on, that's easy. When terms of trade improves, real national income increases because the X divided by PM, the component we add increases. So when you add a higher X divided by PM component or impact of terms of trade component, then the total answer increases. If terms of trade deteriorates, terms of trade decreases, the impact of terms of trade is unfavorable or it becomes negative. So then the real national income decreases. That's the idea. Okay. Then the formula should be, I'll use the purple color marker. The formula should end here. The formula should end there. Fine, we have done what we need to do. We have taken real GNI. We have added the impact of terms of trade on the real GNI. Job done. Then we get the real national income. Then what is that last part? Why do we need that last part? What is that all about? What is this minus XPX part? The problem is, if we don't minus the value of exports in real terms or at constant prices or in real terms, if we don't minus the value of exports at the end, exports are counted twice. What? Exports are counted twice. Look at this. Look at the screen. Here, Buddha, we have net exports. No. Can you tell me what is net exports? X minus M. Harine? Net exports. X minus M. I want responses now. Right? There's a request made by one of your classmates. I'll fulfill that after explaining this. Okay? Yeah. Are you guys clear with me? Yes or no? Come on. You can't say it's too early in the morning to respond. It's past 10 o'clock. On a normal day, you're getting ready for the interval in school. Okay? Right. Good. Thank God. Please respond. Right. Clear. So, when we estimated real GNI, we have taken net exports, which means we have taken exports once. We have taken export once. It is inside net exports, which is added to C plus I plus G, which is inside GDP, which is inside GNI, which is then deflated by dividing with implicit price index into 100. So exports in real terms is already there. Again, do you see here, we see another X. What is this X for? Also exports. Exports is already there. Again, we go and add an export component for the same country. So exports is taken how many times now? Twice. There's a double counting of export value now. So at the end, to complete the formula, to be technically correct, we minus export once. Get it? Otherwise, exports are counted twice. So you minus exports, XPX is that you minus exports once so that there is no what error? Double counting error. There is no double counting error. Right. The only thing that has to go into your mind with this concept is terms of trade has a direct relationship with a concept called real national income. Terms of trade appreciates, real national income increases. Terms of trade depreciates, real national income decreases. Right. There was a request made by one of your classmates to show this part a bit. So I'll have it quickly for a few seconds. Okay. Then put the like in the top part of the page, upper part of the page, towards the end of the page also, I've given you another challenge. Okay, while you guys do this, another challenge. What is the challenge? There are a list of points given for appreciation of terms of trade. I want you to suitably, I hope you guys are listening to me. I want you to suitably, right, adjust these points for a deterioration or decreased depreciation of commodity terms of trade. Same points, adjust. Then you go through them one more time also. You think about them a bit more, which might lead to a more comfortable memory of these things. Are we clear? put pen on paper and do it. Not now, but you can do it on your own. I'm confident. Okay, right. So with that, we complete this part and we go to the next terms of trade related concept, which is called income terms of trade. Most of the time in textbooks and in your paper also, sometimes we refer to this as import feasibility or ability, if not income terms of trade. There's a reason why we call it income terms of trade. Right. So the concept, this is an index. Again, this is also an index, right? Terms of trade are always indexes prepared to import purchasing power. Again, we are showing the import purchasing power. The difference is export income. If I can quickly scroll back a bit, very quickly. Here, it was based on number of imports or import purchasing power of export unit. Export unit කියන්නේ what is it? Export price. Okay. Here, in income terms of trade, Buddha, we are looking at export income or export what? Value. What is value? Sorry. Value. Export value is export price multiplied by export quantity. Is that clear? So this is more comprehensive. Now we are taking value. Right. Then it says, thus, import feasibility of exports is also termed as income. You know where that word came from, right? Because we were looking at the export income here. We were looking at the export income. This is called income terms of trade. What income? Export income. Accordingly, this is the amount of imports that can be derived through the net effect of export price and quantity. We know that, right? I will have stated that already. That is the total value of exports or export income, right? The import feasibility or ability is used by a country to import. This is why we need to know what is our import feasibility. This is why we need to know, because there are three types of things or three types of goods, three reasons one could say that we import things. And again, what was the fundamental principle here? What is the fundamental thought process or way of thinking in international trade? Remember what I said? Identify your comparative advantage, specialize on those goods, generate an excess output, export the excess output. With the income you get, now we can say income, with the income you get, import your non-specialized goods, import the goods upon which you have a comparative disadvantage. That's the base. Pay for your imports using your exports. The moment you can't do that, but you still have to import, then you go into trade deficits, then you go into a major series of problems, and that leads to a world of hurt and pain. Case in point, Sri Lanka. Okay, so the idea is we are going to import using our export income, but what do we import and why do we import? Three things. Read this with me. What does it say? It says the import feasibility or ability used by a country, but it's used by the country to import goods, either they are essential consumer goods. So keeping they are essential goods that we don't make within the country, but we have to import. Okay, essentials. If not, they are what? Intermediate goods, petroleum products, other inputs we need for the production process that are raw materials we need, all that, intermediate goods. Okay, intermediate goods. And then we import capital goods. Sri Lanka imports a lot of capital goods because we can't produce, we don't have the technology to produce the capital goods, machinery, equipment, for our heavy industries, medium, small scale industries, our IT, tech industry, we need to import a lot of machinery and equipments. So what are the three things that especially developing countries like ours tend to import? Essential consumer goods, intermediate goods, and capital goods. To do this, we need to have a feasibility. We need to have an ability. What gives us that ability or feasibility is our income terms of trade or our export income. Our export income. It says now, most of the time we import these things with either we can't produce them here, either we can't produce them or it is uneconomical, meaning excessively costly to produce. It doesn't make sense. So it's better to import, but pay for the import using export. What is the ability or feasibility to do that? That's called income terms of trade. Income terms of trade, right? Income terms of trade can be estimated in two ways, as an index, as a value. So I think I can clearly give this to you with the slide. So we'll go there, right? Hopefully you can see the virtual whiteboard by now. Yeah, right. So yeah, this is done. Don't look at it too much. Right. Then appreciation. Okay, all that is done. Real national income. Income terms of trade, the concept, estimation. Can you guys get this done quickly? Please. Yeah. Okay, are we done? Great. So shall we look at the applications of it? Yeah. So as an index, there are two approaches I have given here, right? Actually, the second is a more explanation of the first approach. Export goods value index, right? Divided by import price index. Then because exports, we only take goods here, but right? Then export, or the other way to get the value, right? What I'm explaining is the value part of it. Other way to get the value is price into the volume. Volume කියන්නේ quantity. Word sounds similar, meaning is different. Price into quantity, right? Divided by the import price index. Then as a value, you can get this by taking the value of exports divided value of export in goods terms, goods exports, not goods and services, only goods exports, divided by import price index, right? Both methods you should be familiar with, right? So can we go to page 21? Application exercises. I have given 5 of them. Yeah, one by one we'll tackle them. So start with the first one, E1. Okay, this is done. Start with E1. Export and import price index numbers with regards to a given economy for the period 2022 are presented as follows. So you have export price index, import price index. Base years are given, base year values are given. A simple requirement is to estimate terms of trade. Goes without saying commodity. So write the formula. So you say terms of trade is export price index divided by import price index into 100. So you apply the values. I'll do it here. Basically, you end up with export price index is 144, 144, divided by import price index is 120, multiplied by 100. So when you solve this, 1, 2 here, yeah, 120. Am I correct? 12, yeah, 120. So that's it. You simply give the answer as 120. Right? Very simple, very straightforward. That's your terms of trade. Now, by looking at the 120, if you want to say whether it's appreciation, increase, decrease of the terms of trade, or appreciation or hold on, depreciation of the terms of trade. Now, that of course depends on if you compare with the previous year or the base year. Base year, there's a 20 basis points improvement, meaning appreciation. Previous year, there could be an appreciation or a depreciation. That depends. Okay, right. Yeah, that's done. Okay, next. Yeah, good. Next. E2. The export price index increased by 50% and the import price index grew by 20% at the end of 2002 from their respective base year value. Base year value is 100. No? From 100, it has come up to increase by 50%. Export prices, import prices have grown by 20%. You are asked to estimate the terms of trade for this year. So again, write the formula. Terms of trade equals export price index divided by import price index into 100. So if you apply the values, export prices, what is the export price index value? Export price index value would be, you have a base year value, which is 100. On this, there is another 50% increase. So that will be 100 plus 50% of 100 is 50, 150. You don't have to show it. I'm just trying to be clear. Import price index base year value is 100. On that, there is another from the base year 20% increase. So 120. So bring those values. 150 divided by 120 into 100. So that would be 125. Yes or no? Because 150 divided by, sorry, 50 divided by 2 and yeah, 125 multiplied by 100. Okay, 125. Correct? Yes, 125. Right. Are we okay? Then E3, there's a correction, not in E3, but there is a correction in E4. Yeah, we'll do it when we get to that. E3. Okay. The import price index of a given economy is 121, 121, base year 100. And the terms of trade is 110, the end of the 2022. Estimate the export price index. Okay. Estimate the export price index. Right. Write the formula and bring the values that we have. Okay. Terms of trade equals export price index. That's what we're trying to find. Divided by the import price index into 100. What do we know about the terms of trade is given 110, 110 equals export price index we are trying to find divided by import price index 121 multiplied by 100. Are we clear? So if I cross this over, 1110 into 121 equals multiplied. So I have 100 px, right? Px. So how much do I get here? Can you give me a value? 110 multiplied by 121. 13, 3. 13,310. Yeah. Yeah. 13,310. So you can do cross multiplication. 13,310 equals 100 px. So space. Anyway, the 13,310 equals 100 px. So we end up with the export price index of 133.1. Yeah. What do you guys think? We are okay? Just to move the values a bit. I'm waiting for a response from you to move to the next question. A small correction also. Done? We are okay? Any questions? No. Okay. Good for you. Question 4, Buddha. Question 4. I have made a small error, right? Here, these two values have to change. That's all. This is 12. This is 10. Okay, can you adjust that and give it a try? Again, the two things you have to apply here. One, you have to understand here, if terms of trade declined from the base year index of 100 by 20 basis points. 20 basis points. So terms of trade has reduced. They are asking, or I'm asking, what should happen if terms of trade has reduced? What should happen to the export price index? What should happen to the import price index if terms of trade is reduced? Tell me, use the knowledge you have from the earlier illustration we did. What should happen? Come on. Terms of trade to decrease, fundamentally, exports should decrease. No, but the fundamental thing is that import should increase. Yes or no? Are you with me or not? Quickly. Right? Come on. Because I have said terms of trade has declined, but I have only said export import. I've used the word change. Change could be increase or decrease. So you can go through several trial and error and come to the answer, or you can apply this knowledge and give it the first time, get the answer. It's about a bit of that knowledge also. Terms of trade has declined. Then in terms of exports, imports, the changes should have been, or should ideally be, exports decreasing. I know those last two situations where exports increase, but imports increase more, where imports decrease, but exports decrease more. That is possible, but the standard thing is this, right? Exports decreasing, imports increasing. So with that in mind, shall we give it a try and see whether we can explain the 80? Now we know terms of trade is 80. How do I know terms of trade is 80? It says from the base year 100, decline by 20 basis points, 20%. 1 basis point means 1%. So decrease by 20 basis points. Right? No, actually there is a technical problem there. $20 basis points. No. Can you adjust that also? I'm very sorry, because technically I have to be correct. I have to say yeah, I think a less confusing approach. Now, central bank 100 basis points is 1%. So 20 basis points is not 20%. 20 basis points is 2%. Get it? So yeah, I'm giving you a question to talk about 20%. So shall we make this 20%? Here also percent. Okay, I'm very sorry for the amount of corrections there, but then we are technically correct. Otherwise, it's not technically correct. Okay, right. So yes, now terms of trade should be 80, no? 20% reduction. So how do we prove this? Let's see if we can do this way. You know the formula, right? Terms of trade is export price index, import price index into 100. Export price index, it says exports and import price. First exports, no, in that order. First exports. Exports 12%. 12%. So 12%, remember here, export should decrease theoretically. I mean, to explain this, decrease. So 100 minus 12, 88. I'm going to take exports as 88, decrease. Imports should increase. So 100 plus 10, 110 multiplied by 100. Can you solve and tell me how much do we get? Yeah, 80. You guys solve it? It's 110 over the 8, no? Yes, we get 80. Yes. So we have explained this. How do we at once got that export should decrease by 12% and import should increase by 12% instead of working out different scenarios? Because we knew if terms of trade has decreased, fundamentally that means exports would have decreased and imports would have increased. We just apply that theory first, that basic thing first. Get it? Right. E5, you guys have to divide the space and quickly tackle this because you don't have space in the next part. Okay. First, I want the answer as a value. Then I want the answer as an index. So when you estimate as a value, what you do is you take the export value index, right? So export rupee value. So export rupee value is 50,000. Do you guys want to do this on your own? Please take 1 minute and do it. Okay. You have the formulas and stuff. Right. Let me know quickly. Okay. Are we done? Yes or no? So as a value, how much is it, Buddha? You have to get a rupee value as the answer. How much did you get? As a value, it should be a rupee value. Okay. As an index, it should be an index value. Okay. Right. Just check this. So basically here as a value, what we do is we take the rupee value of exports divided by the import price index, 125 into 100. Okay. So there are 4, yeah, There are 125s inside 500. So that's 4,000, 40,000. Okay, your answer here should be rupees 40,000. Okay, here as an index, what should we get? Then the formula is export value index 150 divided by 125 into 100. Get it? Into 100. So to 120. Right? Here you get 120. As an index, it's 120. As a rupee value, it's 40,000. Any questions? Are we okay? Okay. So with that, we have completed the terms of trade area. Clear? And after the break, if you guys need one, we will start protectionism, the third chapter. Okay? Protectionism. Right. So I will break for the break. We'll take 20 minutes, not more than that, Putta, and come back to learn all about protectionism. Okay? Right. Right. Welcome back after the break. So we are starting off with Essentials Area 3 or the third chapter, which is the concept of protectionism. And what are the different what is protectionism as a concept? Then what are the different methods or policies that we can use to practice protectionism? Sometimes they are called instruments also. And then how do we know what is the level or degree of protection received by the domestic market, the domestic producers? So there we talk about a special concept called effective rate of protectionism or the rate of effective protection, right? So there are small calculations we need to do there. And with that, we go into a very small, brief discussion. I haven't included that in the material, but using the virtual whiteboard, I will do a discussion on what are the welfare effects of tariff-based protection. So that is also a part that we have to cover. With that, we complete the concept of protection. Right. So let's start then. So if you are looking for a very simple, practical definition for what is protection or protectionism, we could say it is any policy, any measure, any step taken with the intention of restricting. So we say any measure or policy attempts to restrict free trade. Here the word free means without any kind of barriers, tax or non-tax barriers. Get it? Free trade, especially prohibit foreign goods, that is imports, foreign goods, maybe have the S there, foreign goods or import goods entering the domestic market, Okay, so what are you protecting? The domestic market, the domestic producers, from whom the rest of the world, the foreign products coming into the country. This is the basic concept of protection. Anything we do for this purpose with this intention can be called protectionism or a protectionist measure or a protectionist policy. Okay, right. Then there are two ways in which protection works. So we'll write them, shall we? So first, I'm going to focus on the tariff approach, then the non-tariff approach. I've given a list of things we will quickly go through. Right. So let me go to the virtual whiteboard for a bit. Right. Protectionism, the concept is clear. Right. Yeah, can you guys write this? But when you write this part, yeah, under tariff policies or tariff protection, I want to write something. So shall we? Right. Please write Pada in the space in the few 4 lines given there in page 23. Okay. Please write 2 forms. That part is printed. So this part you don't have to write. Okay. This is not required. Number 1, please write tariff policies or tariff protection. Tariff policies or tariff protection. Under that, I want you guys to write 2 points. Okay. First one is, okay. First one is unit or specific tariff or taxes. Okay. Then I want you to write, we can use the word ad valorem. If not, we can say value-based taxes, value-based tariff or percentage tariff, whatever makes it easy for you, right? Value-based or percentage, value-based or percentage, value-based or percentage, value or percentage tariffs. Okay, value or percentage tariffs, right? We don't need to go into a very technical discussion here, but you need to know tariff, non-tariff, right? Then number 2, please write for the non-tariff. Then we elaborate that bit further. That's why it says number 2, non-tariff in the printed part. Okay, number 2, non-tariff policies or non-tariff protection. Done. Right. Then I'll go back to the study material a bit. So that's where I have updated this. Right. So I've given 12. Okay, 12. That's a lot. 12 non-tariff measures. But first 7 I have identified as the most commonly practiced, used, and something that you guys definitely need to know. That's the 7 points there. Okay, right. Just give me 1 minute. Right. Okay. So we start off with, so first of all, are you guys clear? What are import tariffs? Basically, import duties, import taxes. If you want to make a note, sometimes they will use those terms. Import duties. Yes, customs duties, we say import duties, taxes, tariffs. Tariff is a special word we use when it comes to taxes on international trade. We call it tariffs. I'll repeat. When it comes to taxes on international trade, we use a special word that is called tariffs. Get it? Tariffs. Right. That's another word for taxes. Duties. Right. Okay. Then non-tariff. Okay. Non-tariff. Import quota systems. So we can restrict imports and say these products or this particular type of products for a year, the maximum we can bring into the country is restricted with a quota. Now, early until 2005, Sri Lanka used to export our apparel products, our textile products to America, one of our biggest markets. 40% of our apparel exports, garments, go to US market. But until 2005, US had a quota system like this, import quota. USA said, okay, from each country, this is the maximum you can import. You can give it as a value in US dollar terms they had given. If not, you can give it as a quantity, volume, right? So that was called, that quota was called the multi-fiber agreement. It was called the multi-fiber agreement. So that's the way US is controlling the amount of imported garments, apparels coming into their country, import quota, right? Then export subsidies or incentives to domestic producers. Now, when the government of that country gives a subsidy to their exporters, now WTO, World Trade Organization, believes export subsidies is very harmful and very harmful for free and fair international trade. Now, we'll say, for example, China manufactures and exports solar panels, the panels, solar panels to Europe. Then America also manufactures and exports solar panels to Europe. But when the two panels come in, the technology, the product is the same. But when the two panels come into European countries, the Chinese made solar panels are cheaper than that of American made solar panels. Then America complains to the WTO, it's not fair what China is doing. What is America complaining about? Are they complaining that China is making the panels at a lower cost? Chinese companies are making the solar panels at a lower cost, so it's unfair? Not exactly. That is okay. That is due to their efficiency, due to economies of scale. If they are producing at a lower cost, no problem. They have found a new technology to do it, no problem. Cost efficient technology, no issue. But the problem is most Chinese companies are either government owned or heavily subsidized by the Chinese government. So for every solar panel the company is making, the Chinese government is paying them some amount as a subsidy. In Unit 3, we learn subsidies help reduce cost of production. So now for the Chinese company, government is giving a subsidy. Therefore, they can make the same panel that US companies make at a lower cost because of the subsidy. And they export it to European countries at a lower price. But the US government is not giving a subsidy to its companies. They are purely based on their efficiency they are producing. Government is not artificially helping them reduce the cost using taxpayer money. We know in Unit 3 again, we learn whether it's direct intervention or indirect intervention of the government leads to allocative inefficiency. It leads to a overall resource allocation inefficiency, deadweight loss. You get what I'm saying? So what the Chinese government is doing is it's kind of rewarding inefficiency of their companies. But their companies are getting an advantage in the foreign markets, European markets, because of the subsidy. So America is saying it's not fair. So idea is export subsidies could become a barrier for free and fair international trade. Is that clear? Then again, as always, please do clarify if you are not clear. Okay? Right. That's the biggest advantage you guys have by being a part of this live session. Okay? Right. Number 3, imposing voluntary export restraints. Voluntary, VER we say. Voluntary export restraints. Restraints is where you limit yourself, where you control yourself, restraining yourself, right? Voluntary export restraints. Now, a good example in recent times could be, I know you guys might not be very, you don't go in search of this information and keep yourself updated, but end of the day, at least at home, when you're at home, once in a while, when you listen to your parents, when they talk to you, or if someone in the background is talking, some things go into your mind about the, what is this product, this day-to-day commodity food item that became very expensive all of a sudden, I'm sure every Sri Lankan household uses this product as a, to prepare many types of food. And it's kind of a staple we use in preparation of food. People sometimes get emotional when they use this ingredient, or when they, peel it and cut it and chop it. What am I talking about? It's not actual emotions, onions. Very good. Get it? Right. You don't have a emotional attachment with the onion. That's not why you are crying. But onions. Now, in Sri Lanka, Pata, we do make big onions. There are farmers in Sri Lanka, but the big onions that we cultivate are not enough for the domestic requirement. And because we have a limited amount here, the prices are a bit high. So government, looking at the consumer's point of view, what they do is they import. No? Now, recently, your parents might have spoken about this. You might be updated. Big onion prices per kilogram went to about 700, 750, 800 rupees per kilogram. In an same thing, same onions, sometimes you can buy at about 100, 150 rupees, 120 rupees a kilogram, which goes to about 800. So then what the government does is, to stabilize the price a bit, they increase the supply. How do they increase the supply? They start importing onions, big onions. But this time around, when they were trying to import from countries like India, they are the onions that are most according to our palate or our taste, right? Then we can import from Pakistan, Bangladesh, China, these countries also, right? Some other South Pacific Asian country also we import. So anyway, when we try to import from India, the Indian farmers, the Indian exporter, Sri Lankans are the importers, Indian exporters basically said, no, we can't, because we are practicing voluntary export restraints. Now, we are not asking them not to, we haven't stopped the Indian big onions coming into Sri Lanka. They have stopped exporting it to our country because they want to stabilize the price of big onions. They don't want a shortage of big onions in their country. Get what I'm saying? That's why I know now some people say it's not big onions, Bombay loon. Bombay loon, right? But I think we should call it big onions because the big onions we eat not only come from India, unless there's a Bombay in every country. Get what I'm saying? So they have practiced export restraints to make sure their market is stable. So when a country practices voluntary export restraints, it is a barrier for international trade between that country and the other trading partner country. Then imposing import or trade embargoes. Embargoes is a complete blockade. We have talked about embargoes in production possibility frontier, if you remember. It could be voluntarily done by the country, or it could be due to some kind of a dispute between two countries we can have, or it could be between in a region of the world and all these things. But the result of embargoes is it will completely stop trade between those countries or the two countries. Then foreign exchange control. Now, how that affects is to import, right? When we import, we have to pay in foreign currency, especially when we are a smaller economy where we don't have a internationally accepted or internationally used currency, right? Sri Lankan rupee is not one of the top international payment currencies. Get it? It's the US dollar, then the sterling pound and stuff like that. So euro and things like that, but the Chinese yuan to a certain extent, Indian rupee to a certain extent. So what happens is when we import, we have to pay in US dollars. If we want to restrict imports, during the COVID lockdown periods, we did this. Then during the economic crisis of 2022, we did this, right? What the central bank? Central bank is the exchange controller. Central bank is the foreign exchange controller, right? So what they do is they purposefully reduce the amount of foreign currency available in the domestic forex market, foreign exchange market. Basically, they make sure all the commercial banks and the authorized money dealers have less foreign currency. Central bank will absorb some foreign currency and reduce the availability of forex. Once they reduce the availability of forex, you can't actually import because you can't pay for your imports. Shortage of foreign currency is there. You can't open the LCs and things like that. Get it? Right. Dumping. We'll talk about that. Don't worry. Right. Dumping is also seen as a restrictive trade practice that will lead to discouraging trade between countries. I'll explain that in the next page. It's there. Then with the prescribing administrative and technical standards, setting very strict, sometimes a bit impractical administrative standards. So here the administrative standards, quality standards, safety standards, these things are set with a not with the intention of discouraging the import. They sometimes make it ridiculously impossible to meet those standards, especially sometimes European countries do this. Sometimes other Western countries that Sri Lanka exports, they do is they come up with, they say, okay, we have changed the standard upgrade is there. Now the product needs to have these quality certifications, these specifications. If you have used these ingredients in a product, you can't bring it to our country. If it's a food item, it has to have that standard, this standard, and then they will have these documentation requirements. They will ask ridiculous questions like, whoever the person who has, making the product, invented the technology, what is their, some information you can't find, right? So they will make, these are called something administrative hampering, restricting, making it difficult, right? That's another way to reduce the imports that come into a country. Now that's why I'm sure you guys have heard European standards, uh, the British standards have to be followed, and once you have to do all that, it becomes for especially exporters from developing countries, infant industries like Sri Lanka, becomes very difficult. Got it? Right. So that is 1 to 7. Additionally, I have given, yes, another about 5 points. If you can take something from that, definitely add that also, because if you can remember about 10 points, it's always a good thing to have in your bag. Bag in the sense, not literally in the bag, but right. Intellectual property laws, patent licenses, trademarks, copyright. Now, this is one of the biggest accusations we have against China. They don't respect this. So for China, these are not barriers. They don't care about IP and all that. Now they have changed a bit, but those days or until recently. Then preferential and government procurement policies. Procurement policies is especially if the government purchases something, if they're importing some new machinery, something like that, government can have very strict procurement policies, right? By having these very strict procurement policies also, government can discourage the import. Then local content provisions and mandatory rules of origin, certain things you need to have, for example, now in the entertainment industry, right? Now, Sri Lanka had, and I think still have, a trend where we buy these long-running soap opera type series from India, right? And we buy the broadcasting rights, our channels, local channels, right? And then what happens is there are only limited amount of hours, they can allocate during the prime time of television, right? So what happens is they give those teledramas the priority and they show them, right? Whereas the Sri Lankan producers who make Sri Lankan actors and our industry who makes teledramas and all that, we can't show our teledramas on the channels because they are crowded by the foreign dramas, the Indian ones, the Korean ones, whatever it is. So to protect the Sri Lankan teledrama industry, sometimes the government would say, okay, if your airtime for a day is this number of hours, only this percentage you can show foreign content. The others have to be local content. That way you are restricting the foreign content and you are promoting the local content. That is also a method, right? And mandatory rules of origin, where the certain inputs have to come from this country. You can't bring those inputs from other countries, something like that. Regional economic cooperation and enforcing trade agreements. That part also I will separately talk about under economic integration. Finally, import-export permits and licensing can also creating cartels where suppliers work together, like the OPEC organization. These things all act as barriers, non-tariff barriers for restrictive measures for international trade. Okay, right. Then before we go into the arguments, there are also the term dumping is there. So I'll explain that first. Can you guys go to page 24 and give it a read once? Quickly read what is given here. The practice of dumping in international trade. Special note, page 24. Okay. Now, at the end of the first para, or the first sentence at least, you get a reasonably good idea of what dumping is. Okay, there are few ways to define the concept. The fundamental idea is when you sell a product in a foreign country at a price lesser or lower than what you would sell it in your home country, then we say there is a dumping incident or incidence is there or practice is there. We can define dumping from a cost perspective also. So there it's very simple, Buddha. When you price the product in whatever the foreign country you sell the product, the country you export the product to, for that country it's an import, right? In a foreign country, if you sell a product at a price which is lower than your average total cost, which is lower than the cost to produce the product in your country, if you sell it at a lower price, then that's called dumping. Now, two questions can come about in your mind. One is, why would a country want to sell a product in another country at a price or cost, at a price or a price lower than the price it sells the product in its country, home country, or why at a price lower than its cost? First question. Second question is, so what's so wrong about this? What's so bad about this? Let's answer the questions. First thing is, the objective here is two things. One is to sell a huge volume of it. Get it? At a very, very low price, you try to sell a massive quantity. That's where the word comes from. You bring this huge quantity of the product and dump it on that country at a dirt cheap price. First thing. Second thing is, then you might, as I said, you might ask, okay, why would they, aren't they making losses by selling the product at a lesser price in the foreign country than the price in their country, or lesser than the cost, average total cost? What do you think? Why would that make sense for them? They're selling a large volume, but still they could make losses. Why are they doing that? There, what happens is, they have a exchange rate, foreign exchange rate advantage, because their currencies, if their currency is strong, right, they can get an advantage from that. Are we clear? So what happens is, with the foreign exchange rate, the margin they have, the advantage they have, plus being able to sell a large volume. Countries like China are famously known for practicing dumping in countries like ours, and especially in many African countries, they do this a lot. Now, they target countries where consumers have low income, and consumers will always value products being cheaper than the quality or the standards of the product. None of these products that are used for dumping Buddha are these high quality, essential, luxury. No, not those. Most of them are basically useless things, impulse things we buy, right? We buy it and we take it home, and after that we ask ourselves a question: what do I do with this? Why did I buy this? Why did I need this? Those kinds of things, right? We simply buy it. Why? If you don't need it, then if you are confused with what to do with it at home, why did we buy it in the first place? We simply bought it because it's given at such a low price. So don't misunderstand. Companies who are practicing dumping are not giving the product at a lower price on a charitable basis or thinking about the poor consumers in our countries. No, no, no. They are doing that as a strategy to sell large volumes and to exploit out most of the small purchasing power we have and take a lot of foreign money out of our country. And they're doing that because the exchange rate advantage, they can make quite a big amount of profits. Okay, right. Next question is, what's so bad about this? So what if they do it? The problem is when a country like China practices dumping Buddha. Now, for example, China is famously known for practicing dumping using footwear, shoes. They make this, very basic quality, sometimes inferior quality. You wear it once, you wear it twice, the third time, done, right? So they make shoes, footwear. They have these factories in China where they make about million pairs of shoes for a day. Get it? Just continuously they make it. Right. That's okay. But much as possible, try to stay with the class. But sorry, one of your friends is having a small connectivity issue. Whenever possible, try to stay with the class and make sure. Definitely now, since you guys have fully got into the virtual class, and once you got the payment link and all that in your WhatsApp groups. So once you follow that and do the needful, the recordings will be made available for you. Right? Was anyone able to watch the recording from last week? Is it available? Did anyone have a look at it? Yeah? No? Right. Once you have, made the payments and whatever it is, and logged in to the classroom, it should be available, right? If not, I'll just update the coordinator also, the technical coordinator. They will also try to make it available. So please, if you have any bandwidth issues for the live class, remember, you can go to the recording, and any student who was there without any technical issue during the full stretch of the live class, also as a recap, as a point of clarification, use the video resources. Use the video resources. Is that clear? Right. I will try to keep them available as much as possible. Okay, as long as possible, if that is the way to put it. Right. Coming back to the point I was making, what's so bad about this? Now, the thing is this: when countries like China make footwear, right, at a dirt cheap price in these huge factories with massive economies of scale, and then they come and practice dumping and give the pair of shoes for about 400 rupees, right? Exteriorly or outer look is very decent, right? When they give it to 400 rupees, when the Sri Lankan manufacturers, our small, medium, and a few large-scale manufacturers, where we don't have those economies, where we don't have that, technology efficiency and all that. When our manufacturers make the same shoe, they sell for 4,000. So there's that much of a gap, tenfold gap in the price. And remember, that gap is increased because they are practicing dumping. So our domestic manufacturers of those products that are subject to dumping quota have absolutely no chance. And on top of that, dumping could be defined as where they're selling at lower than their cost also. Get it? So the biggest problem with dumping is it's a massive negative impact or blow on the domestic manufacturers, domestic producers. Got it? Right. That's why the WTO also believed is unfair trade practice, right? Or they call it, it's a nice term. Here we go. Predatory. Like, these hunting animals, you see the thing and you go for the kill. Get it? Predatory. And it's definitely what discrimination? Price discrimination. Why? Because in their home country, the same product, their customers have to pay a high price. But in that other country, they sell at a lower price. Because dumping typically involves substantial export volumes, substantial, big amounts, substantial export volumes of a product often endangers the financial viability of the product's manufacturer or producer in the importing nation. Our domestic producer is hurt economically, financially, and perhaps emotionally also. Right. What are the major arguments against protection? Arguments against protection. Okay. Why we shouldn't practice protection? No, sorry, we skipped something. Before that, we'll ask the question, why should we practice protection? Let's start there. Okay, right. I've given 8 points arguing why protection is needed, reasons for protection. We'll quickly go through them, they're very simple. Protecting the domestic infant, sometimes called sunrise industries, they're just coming up. They need some, but when you're at what age do you need your parents to protect you the most? At what age do you need your parents to protect you the most? Where you can't protect yourself. When you're doing O levels, A levels, after you get married, where do you need the protection the most? Where you don't know what's going on. Very good. When we are babies. Yeah, right. The term we like to use is infancy, at your infancy. So Sri Lankan, most of our industries are not mature industries, no. We still haven't perfected the technology. We still haven't perfected the, product. We are still in the development stage. We are in the infancy. So we can't compete with the foreign brands who come from very mature industries in their countries, where they have perfected everything. So we need protection. Got it? Then national security and protecting strategically important industries. True. There is also a very, very forceful argument for practicing protection. Now, what is the social platform, social networking platform, I think, or social media platform that America is trying to ban, America is trying to prohibit? Very common information I'm asking. Anyone? Rahmi, very good. Ilma, very good. What is this social network platform that America is prohibiting? They're trying to prohibit, or they are, putting a lot of pressure on. Kena, yes, very good. Yeah, the platform called TikTok. No, the parent company it's a Chinese based company. I don't know what their name now is. They used to be called Dance Music or something, right? So they now the American government's argument is they are saying using TikTok, China is gathering a lot of data from the American people who have subscribed to the platform or people who are on TikTok. They are getting a lot of data and information, and they are communicating. That's what they're saying. They're communicating that information to the Chinese government, in turn creating a national security risk for China. A lot of scams and all those things. So they are using that national security citizen protection argument. They are trying to prohibit TikTok. No? Now, for example, you might have heard of a Chinese tech company, tech giant called Huawei. No? Now, they make a lot of these components for communication and, 5G technology and all those things, Internet of Things and everything. So what happens is when Huawei tried to export most of their components and things to European countries, they said no, prohibited. We stop. We can't allow because you will spy on us. You will use that data and do something against our economy and stuff like that, right? And certain strategically important. In Sri Lanka, we have this thing, right? Our electricity industry, our petroleum industry. We are a bit concerned. We are a bit, thinking twice, one would say, before we hand over big control to Indian companies. No, because it's a strategic industry for us. Got it? Things like that. Then protecting and enhancing domestic employment. That is true, right? Because with the imports, it's a trade. Trading creates jobs in the shops and outlets and all that, but nothing creates as nothing creates as much employment opportunities and use of resources like manufacturing things within the country. So domestic industries are job creators, but when most domestic industries close down or collapse due to imports, due to a lack of protection, that could lead to an employment issue. Economic diversification, as I said earlier, we talked about diversification to maintain a bit of domestic stability without depending too much on imports. There's a nice word that we use for this. As a country, we need to develop economic resilience. What is the word? Economic resilience. The ability to withstand the external shocks we get. Every time in a Gulf country, in a Middle Eastern country, when there's a conflict that breaks out, which happens very often, the petroleum markets, crude oil prices start to change, and we are affected like nothing because we don't have that resilience. We are over dependent on that. We haven't diversified enough for our energy, for our machinery equipment that we need for manufacturing and all that, right? Then strengthening the balance of payment problems. Yeah. Now, if we have a persisting trade deficit and a current account deficit in the BOP, right? Then we need to try to find a way to risk. Now, that is again during the pandemic time, and then during the 2022 economic crisis time, central bank was taking a lot of steps. I assume you guys remember. There at one point there were about 400-500 items or more on an import restriction list where you can't import. They are prohibited. So directly they were controlling imports because we had a major outflowing of foreign currency and a very less inflow of foreign currency. We had a massive trade deficit problem. So we are trying to plug that leak or gap by restricting imports. Got it? Now vehicles and things, even still we have kept it restricted. No? Then eliminating the practice of dumping. We talked about it all together now, right? When you want to eliminate dumping, one type of taxes that Sri Lanka doesn't have, because we don't still have an anti-dumping law. I think when our present president was prime minister 5 years ago or whatever, during the good governance government, there was a discussion. I'm not actually sure about whether it was passed in the parliament, anti-dumping law, right? China was not very happy about it, right? So the taxes you have, tariffs you have against dumping is called countervailing duty. It's just a term, right? Don't overdo it, but just if you can remember, good. Countervailing duty. Then discouraging the imports of demerit goods. That's also argument for protection, things like alcohol, cigarettes, all that. Generating income to the government. Now, I have given that as a last point. Income to the government. So, what does that mean? The purpose of taxes or tariffs on imports is the first and the main reason is not government to earn income. Sometimes we do feel like the intention of the Sri Lankan government is purely earn income from it. But in economics, we argue that's a kind of a byproduct. As an additional benefit, the government is getting income from charging tariffs on imports. But mainly those first seven are the more powerful arguments for this. More powerful arguments for this. Got it? Right. So we talked about dumping. Now let's quickly write the arguments against protection. Why we shouldn't prohibit, restrict free international trade. Okay. Both sides you need to know these are tested a lot. Okay. Right. So what are countervailing duty? Purposefully, I didn't go into it. I didn't explain it. For now, you just simply have to know countervailing duty is a type of tariff that will discourage dumping. That's it. Don't go beyond that. The general idea of countervailing tax or duty is now they will say in their country they sell the shoes, footwear example. They sell it at 600 in Sri Lankan rupee terms. Okay, 600 rupees, but in Sri Lanka they sell it at 200 rupees. Sorry, sell it at 400 rupees. Now that means as a gap of 200. No? You can find that gap and charge a tax to bring it to the same price. That kind of an idea. Is that clear? Right. But leave it there. Don't go beyond that. Right. What are the main arguments against protection? Arguments against protection. Why we shouldn't practice protectionism. Okay. Right. So just give me a minute, Pata. I'll try to give you the arguments based on a marking scheme. If not, I can just use the slide. Okay, just give me one minute or two. Right. The points that I'm about to give you guys, right, we'll simply state them, are fundamentally from the 2023 advanced level paper, the marking scheme, right? The exam was held this year. You guys know that, no? Right? Okay. So the question, okay, the question was basically distinguish between the concepts of no, sorry. Question was provide two arguments. They're asking for two arguments each for and against the protectionism in international trade. Protectionism in international trade. It's a 4-mark question, right? Stating should be okay, but since they have used the word argument, maybe a brief explanation is also good in a question like that, right? So we'll write the points and I'll maybe read out some of the explanations that are given also. You don't write them, but you can listen. Shall we? Right. So to reduce distractions, I will stop the video for a bit, but I will keep reading the points. You guys can write. Okay? Right. Number 1, resource misallocation. Resource misallocation. Within brackets, possible allocative inefficiency. So I'm going to repeat the entire thing one more time. Resource misallocation, within brackets, possible allocative inefficiency. Possible allocative inefficiency or possibility of allocative inefficiency. Right. Now I'm going to read a small description. Just listen. Really, really, really concentrate and listen. Okay? Right. I'll read it clearly as possible. Protectionism lead to inefficient allocation of resources. When industries are protected, they may not have the same incentive to become efficient and innovate as they would under competition. This can result in wasted resources and lower overall economic growth. Get it? Lower overall economic growth. So resource inefficient, allocative inefficiency and less economic growth. Right. Then, second point, please write. Higher consumer prices. Higher consumer prices. Within brackets, right? Within brackets, right? Reducing domestic consumers, within brackets we are writing, reducing domestic consumers, purchasing power and range of choice, R-A-N-G-E, range of choice, reducing domestic consumers, purchasing power and range of choice, domestic consumers, purchasing power and range of choice, range of choice, close the brackets. Right. So let me read the small description. Listen carefully. Tariffs and quotas typically lead to higher prices for import goods, which can hurt consumers by reducing their purchasing power and limiting choices in the marketplace. Limiting choices in the marketplace. Right. Third point, please write retaliation. Retaliation. Okay. Just give me a minute. Retaliation. Retaliation. So what does retaliation mean? A negative reaction, a tit for tat kind of a thing, you know. You hit me, I'll hit you. You charge tariffs on our products that come in. When you export to our country, we will also charge a tariff. Now, a good example I can give you guys is when we had the good governance government Buddha at one point, because of the proven and accepted health hazards or health negative health impact of asbestos that we have in our homes and construction and roofing and all that, the government of Sri Lanka decided to go for a complete prohibition, complete ban on asbestos products. They gave a deadline and said after this year, we can't import asbestos, we can't use asbestos, we are going to completely phase out asbestos in our construction industry. Then after that was introduced by the government and all that, when the asbestos ban came into action, after about 1 month's time, one of the countries in the world that we export tea in a big way, a large amount of tea we export is Russia. Russia buy Sri Lankan tea a big amount. So what happened was, Buddha, we exported tea to when one of our tea shipments, a big shipment went to Russia. Russia all of a sudden stopped that shipment from going into the country at the port itself, and they said, no, we can't take this. We are rejecting this shipment, tea from Sri Lanka. And they said, no, there's a health and safety issue here, because apparently not inside but outside of one of the crates, one of the containers or the boxes or whatever, they have found a beetle, kind of a bug. Okay, few or one or two or whatever, and they have taken photographic evidence, and they were saying, no, my God, we can't give our people bug infested tea, right? Even though the protein content would be high, but we can't give, this health and safety. So my God, they were about to completely prohibit tea from Sri Lanka coming into Russia. And this was the first time it has happened. Sri Lanka has been exporting tea to Russia for decades. And then some biological scientists or whatever, they looked at those pictures of that beetle they were showing and all that. And then they were arguing this particular species of beetles are not in Sri Lanka. They don't live in Sri Lanka. So how did this get to the tea? You get what I'm saying? So then after some time, it took us a bit of time, but after some time we realized main country that makes and exports asbestos to Sri Lanka is Russia. Whatever the asbestos Sri Lanka imports, majority we import from Russia. Now, when Sri Lankan government came up with the asbestos ban, who was hurt? Russia was hurt. So what did Russia do? They retaliated. How did they retaliate? They found a bug in the tea. They for health and safety reason, they were trying to stop Sri Lankan tea from going to Russia. You get what I'm saying? This is called what? With a retaliation, tit for tat. Okay. So right. So within brackets, right? Overall reduction in global trade. After writing retaliation, within brackets, right? With the overall reduction in global trade. 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 Global trade. Right. Next. Okay, please write. Reduce number 4. Reduce economic welfare. Reduces or reduced is better. Reduced economic welfare. Reduced economic welfare. Reduced economic welfare. Okay, reduced economic welfare. Within brackets, right? Within brackets, right? Inability. Okay, within brackets, right? Put that inability to derive. Inability to derive optimum benefits. Inability to derive optimum benefits. Optimum benefits from comparative advantage based international trade. I'll repeat. Inability to derive optimum benefits from comparative advantage based international trade. Close the brackets. Next point. Limits. Innovation and competition. Limits innovation and competition. Limits innovation and competition. Within brackets, right? Disincentive. Within brackets, right? Disincentive towards competition and dynamic innovation. Keep innovating with the changes that happens. Dynamic innovation. Disincentive for competition and dynamic innovation. Next point or next argument against protectionism. Complexity and bureaucracy. Complexity and bureaucracy. Can I spell bureaucracy for you guys? Please listen and write properly. Bureaucracy. It's pronounced one way but written a bit differently, no? Bureaucracy. I'll repeat. Bureaucracy. Bureaucracy. Okay. Yes, but I have requested to repeat the point. The one I just read, am I correct? Yes, complexity and bureaucracy. I'll spell bureaucracy one more time because it's a word I've seen being misspelled a lot. Bureaucracy. Bureaucracy. Niladari Vadaya. Bureaucracy. Okay, done? Right. So basically, if you want to practice protection, you have to come up with a lot of institutions, systems, the customs has to get involved. So many forms have to come in, procedures have to come in. All that is bureaucracy. At each point, there will be some person, some official who has to approve something, to fill something, to sign something, stamp something. All this leads to corruption also. Right? That's another point. This will lead to a lot of corruption also. Right. Finally, please write inefficient number. Which number is, what are we writing now? 7, yes? Am I correct? 6, 7? Anyway, please write inefficient, 7, good. Inefficient rent seeking. R-E-N-T, rent seeking. As in seeking, S-E-E-K-I-N-G, seeking, rent seeking. Within brackets, write special interest groups. Special interest groups lobby, LOBBY, special interest groups lobby, LOBBY, lobby for self-interested commonly harmful self-interested, commonly harmful protection. Self-interested, commonly harmful protection. Full stop. Close the brackets, full stop. So after rent seeking, okay, I assume a connectivity problem. After rent seeking, within brackets, we wrote special interest groups, lobby for self-interested, okay, self-interested, what did I say about the other? Self-interested, because I'm not reading it out of the thing, I'm summarizing it for you. Self-interested, commonly harmful. Am I correct? Commonly harmful protection. Commonly harmful protection. Okay, right. Then commonly harmful protection. Right. Right. Yes, commonly harmful protection. Close brackets. Right. Few things. Rent seeking is where you seek certain special privileges. Special privileges. Are we okay with the word lobby? You know, where do you hear the word lobby a lot? What kind of buildings? Where? They use this word lobby a lot in hotels, no? So hotels, conference halls and all that. So lobbying is where actually you meet politicians, decision makers in the lobby, in between meetings, and you try to influence them. You try to make your case and convince them to do things. That is called lobbying. There are specialists, lobbyists are there. That's a job title, right? Expert lobbyists are there. They in different fields. They are the ones who know how to talk to these people and get the job done. So special interest groups, now these different associations, for example, the Sri Lanka, tile manufacturers association, the special interest group, because their interest is on the tile manufacturers. So they will go and speak to the government and say, don't allow any imported tiles to come in. Our industry is affected, that and this and all that. Then what happens is they will do that and they will have very unreasonable margins and sell their tiles, where the consumers are really harmfully affected because we have to pay thumping amounts and buy tiles, whereas if we had imported them, half the price we can get the tiles. Get it? So this is a very common thing we see in protectionism, common issue we see with protectionism, right? Hopefully you guys are clear. So those are the updated, upgraded, we'll say. No, updated is better. Arguments against protectionism, right? So that part is done. Now let's see how we measure the protectionism. How much protection is received by the domestic producers. So there are two concepts, very simple. Don't overthink: nominal protection and effective protection. So nominal protection. So it says protection received by domestically produced goods, domestic producers, because of the relative price increase in the domestic market price of an imported good due to import tariff is known as nominal protection. Some of the things here, when we do the application exercise, it will make sense. Okay. Then Buddha, it says nominal rate of protection. So first I'm explaining the concept of nominal protection. Then, okay, here we explain the concept of nominal protection, right? The concept. Now we are looking at how to measure it. Nominal rate of protection. Nominal rate of protection is measured based on the concept of nominal rate of protection. This is the percentage. Basically, it is the percentage increase in the price of the imported good. So basically, the relative to the price before the tariff due to a tariff, right? In the price of the domestic product due to a tariff is known as the nominal rate of protection or any other means of protection. Basically, Buddha, there is no calculation to be done here. Now, if the government says to protect the domestic footwear industry, we are going to go for a special import tariff of 25% on all imported shoes. Get it? On all imported shoes. How much? 25%. If I ask you a question, what is the nominal rate of protection? What is your answer? Every pair of shoes imported to Sri Lanka, its price will increase by how much? 25%. So this here is the NPR, nominal rate of protection. No calculation required. Nominal rate of protection is basically the percentage protection given tax, percentage of the tax. Nominal rate of protection. Now, isn't that good enough? Why do we need to talk about this more? The issue is nominal rate of protection does not give us any idea. Nominal rate of protection does not give us any idea. Are you guys with me? Right? Does not give us any idea. Okay. I was just checking whether I remember pausing the recording earlier. No, it's recording. Thank God. Does not give us any idea, nominal rate of protection, okay? Does not give us any idea of has the domestic producers been able to actually improve their value addition? Are they genuinely getting a protection from the government by doing this? First thing, value addition, impact on the value addition is not shown. We don't have an idea. Second problem we have with the nominal rate of protection is it only considers the tariff on the imported final good. Now the shoe is the final good. But now there are Sri Lankan footwear manufacturers, no? They also import a lot of raw materials, intermediate goods. Sometimes the government has tariffs on the intermediate goods. So it is negatively affecting them, the domestic producer. So nominal rate of protection is not very comprehensive. It only looks at the tariff on the final good and it doesn't show us the impact on the what addition? Value addition. Therefore, understanding these limitations, which I've explained here, I'm not going to go through them point by point, but if you guys read, you will see this is what I explained. Because of these limitations, we argue, right? Because of these limitations, we argue that, okay? We argue that, right? We argue that we should have a better way to look at this, better way to get an idea of the effective protection receipt. So we come up with a concept called what? The effective rate of protection. If you ask in the exam, what is effective rate of protection? Then the concept is clear. Okay, the T has gone somewhere. Anyway, the concept is the rate, right? The rate of effective protection, real protection, actual protection, available local producers, where the domestic value addition has increased. And we look at the tariffs not only on the final good, but also on the imported raw material. All those problems we had are addressed now. Value addition is considered. We are looking at the, okay, we are looking at the value addition, and we are looking at the tariff not only on the final good, also on the imported raw material, also on the imported raw material. Okay, also on the imported raw material. Right. So how do we measure the effective rate of protection? Are you guys okay up to now? Yeah. Are you clear on the differences between nominal and effective? Yes or no? Two main points. If you're not clear, please do ask questions. Okay. Right. Right. Then we look at the a simple formula. It's very simple. It's basically a percentage calculation that we have to do, right? So if I remember correctly, I have this very clearly on the virtual whiteboard. Okay, I might be wrong. I remember that. Let's see. Here we go. Right. This I have just extracted from one of the slides done by your professor. Okay. So can you write this, please? I would recommend something like this. In the box given, write V1 minus V0 divided by V0. If you want, you can say multiplied by 100, or you'll get the answer as a fraction. That's okay, right? Then Pratap, in the lines given there, can you explain what is V1 and V0? Explain what is V1 and V0 in the lines given there. Get it? Right. Quickly do it. ERP. In economics, ERP is effective rate of protection. In business studies, what is ERP? I'm sure business studies, accounting, you guys have finished the syllabuses, no? Only economics is lagging behind, right? So you've learned everything. In business studies, what is ERP? While you write this, answer my question. No, you haven't finished the syllabus, right? Still, I'm sure. Akila, very good. Yes. I'm not going to say it out loud, but can I know where do you study business studies? With whom are you studying business studies? Just for me to know, Buddha. Anyone else? Can you tell me what is ERP? This I can say actually. I don't go for classes. Very good, Buddha. No, I'm not saying not to go for classes, but right? So what is ERP? I have mentioned this a few times, I think in Unit 4, somewhere. ERP. Anyone? No? Maybe you haven't done this still, but I don't know where this comes in, which lesson of business studies. But definitely something you guys should learn somewhere. We call it enterprise resource planning. ERP systems are there. Business needs to run on a certain system. Right now, I'm sure you have learned things like MK, management information system, marketing information system, financial information systems. So ERPs, what they do is they help the business plan their all their operations, entire operation. It's a very strategic thing, right? Some of the very well-known ERP systems out there are, you might have heard, big companies use things like SAP, SAP. SAP is a very popular integrated enterprise resource planning system used by many companies in Sri Lanka. Then Oracle is there, right? Likewise, there are many systems. So in business studies, in the world also, very common use of the abbreviation ERP is enterprise resource planning. In economics, ERP in this case is for effective rate of protection. Okay, good. My commerce students, right, done. Shall we? Yeah, there's a request from one of your classmates. Can sir again explain what is ERP? Okay, now I have to have a disclaimer, Buddha, right? Because I don't want you to learn ERPs from me, because in A levels, for many things, there is a certain definition, right? But I can give you a general idea about what a ERP is. That's all I'm doing. Are we okay? Right. So basically, ERP or enterprise resource planning, it's a process. It's a system. Each company, especially for a large business, you have to have a way of how you are going to optimize your resources and plan your basically plan your business. Hold on. My God, I'm about to waste my time. In economics, effective rate of protectionism, is that what you're asking? Yeah, okay. Effective rate of protectionism, in simple terms, is due to a tariff protection, due to an implementation of a tariff, at what percentage has the value addition of the domestic producers increased? Simply, that is what effective rate of protection is. In the process of estimating the value addition, we should consider not only tariff on the final good, also the intermediate goods or the raw materials. That's it. Is that clear? Simply one line answer is ERP is percentage increase in the domestic value addition. Domestic producers value addition. That's called effective rate of protection. Our protection is only effective if the domestic value addition has increased. Get it? Right. Let's do the question. That will also give more clarity. Okay. Right. The student who wanted me to explain, I hope you got your answer. If you didn't, let me know. We'll take another approach. Right. So we start with the first application exercise. The basic information is given. Basic information is given in page 25. So what is given to you is right? I'll just bring it here. You are given that the market price of a good domestic price is 500 rupees. Value of imported intermediate goods is 300. Value added in domestic production is 200, right? So the final price of the imported good is 500. Okay, so the imported good and the domestic product is sold at the same price. Then government has decided to import a tariff, underline, highlight, final good. On the final good of 10%. Only on the final good, right? Okay, you guys realize, right, this difference, what this is? Basically how this 200 is created. Price is 500, okay? Minus raw materials, intermediate input. Remember, you guys know this, no? How do we calculate value addition? Gross value of output minus intermediate consumption. That doesn't change. So here the gross value of output is 500. Money value of the output, 500. 1 unit now we are talking about 500 minus intermediate consumption is 300. So this is basically how this 200 is calculated. It's already given to you, value added in domestic production. Is that clear? Right. Okay. Anyway, the first requirement is what? The only requirement is actually estimate the effective rate of protection, ERP. Okay. Can you guys give it a try? You have space in page 26. But write the formula first. Do that. I'm just recommending something, okay? Right? You decide how to manage the space. Write the formula, that is effective rate of protection equals V1 minus V0 divided by V0. We'll multiply with 100, so we get a percentage. Okay? Right. Now apply the values. How much is V1? that you might need to do a calculation and find out. How do we calculate? What is the price of the imported good before the tariff? 500. On that 500, how much is the tariff? 10%. So calculate 10% of 500 and add it to the 500. Calculate. I'm breaking it down so that it's easy for you. If not, you can directly calculate 10% on the 500, right? And then calculate the new value addition. Without the tariff, the value addition is 200 rupees. Remember, domestic producers will sell at whatever the price the imported product is sold. That is the catch here. If I show you a calculation, 500 plus 10% of 500 minus 300. So the domestic, now hold on. Just give me a minute here. What is this 550? Look at the virtual whiteboard. What is this 550? This is the price sold or charged by domestic producers after tariff. Is that clear? Now you might ask, hold on, wasn't the tariff on the imported final good? Then how is the domestic producer charging 550? The domestic producers will always match the price imported product is sold. So domestic producers will sell at the same price as the imported product. Get it? That's how their value addition pumps up. Get it? That's how their value addition increases. So if that is clear, you will get the calculation. Right? So earlier, the domestic producers value addition is given in the question, 200. Now it's 250. Now it's how much, brother? 250. So bring that 250 here and you can easily do the calculation. Can anyone tell me what is the effective rate of protection, by the way? Anyone who has completed the calculation? If V1 is 250, V0 is already given 200. What is the effective rate of protection? Is? Come on. Give me the answer. Ayyo. This is not economics. Basic mathematics now. 25 what? Rupees or percentage? Give me a percentage, not a fraction. Give me a percentage, not an absolute value. 25%. Very good. There we go. Okay? Right. So, are we clear with that? I've given two ways to calculate the value addition. The alternative method is what? We just look at how much the tariff will increase the value addition. First method, we calculate the value addition. Second method, we look at the change in value addition. Either way, we are okay. .25 or 25% is the ideal answer. Okay. If you can give. Right. Done. Any questions? Anything to clarify? Quickly ask. No? No. Okay. Good for you. Then let's look at exercise 2. Same thing, but with a twist. Now, there's a tariff on intermediate goods. Can you highlight that? Yeah, this I have given to you guys clearly, no? So we don't need this slide. Right. Can you highlight the difference? The difference is now there is not only a tariff on the final good, but also the intermediate good. Without the concept, the application, everything is the same. It's just an additional small complication. That's all. Okay, nothing changes beyond that. Okay, how would you calculate the, now again, they're asking for ERP, no? So ERP is always, effective rate of protection is always V1 minus V0 divided by V0 into 100. That doesn't change, right? Or if the 100 is not there, that's okay, but that's a formula. How do you calculate V1 now? Now, we have to take the 500, okay, add 10% on the 500, that's 0.10, okay, because the price will increase because of the tariff on the final good. That's done. Minus, we earlier just said minus 300. Now, there is a tariff on the imported raw material also. Into 5%, 0.05. So this bit of a lengthy calculation is what we have to do. Do that and tell me how much do we get. Here you get 550 minus 10%. Yeah. Okay. The applications are correct. Right. Okay. Any moment now, I'm waiting for the value addition. I'm waiting for V1. Sure. How much? 235. Did you all do the calculation or did you all went with what I have on this virtual whiteboard? Okay. Okay. So then V0 doesn't change. It's still 200. Do the calculation. The alternative method, I think you guys are okay. No, we don't have to show everything. I'm going to clear this with us so that everything doesn't get mixed up. Okay, 235. Then bring that. I've shown the alternative method also. That's purely additional. How much do we get? 17.5%. Very good. Yeah. 17.5%. Get it? So what did that 5% tariff on intermediate goods do? It reduced the protection. Effective protection was reduced from 25%. Now it's 17.5%. 5%, 17.5%. Get it? Okay. Right. Again, I ask if there's anything you want me to clarify, please do let me know. If not, this is how the process works. There's an alternative common formula, which I believe it's good for you to know. I would like to use that formula and also quickly do this calculation, because that formula helps us understand, Buddha, what would increase and decrease the effective rate of protection. Okay. So if you're done here, I want you to go to page 27 and have a look at the common formula. Right? Have a look at the common formula. Are you okay here? Can I get a feedback, please? Done? So some of your friends, even the first session, I noticed this. Second session also, I'm seeing the same trend. Few of you guys or your friends, they are already left, so they're not hearing what I'm saying. But you can communicate also to them. Seem to last 10 minutes, 15 minutes, they basically log off. Maybe there's something that they have to do. That's okay, I understand. But they then have the responsibility, Pata, to tick the box that says I have completed the session. Then once the recorded version is uploaded or available, they need to at least watch the last 10, 15, 20 minutes. Get it? They have to complete that part also. Okay. There's nothing saying that, Buddha, towards the last 10, 15 minutes, nothing important is done. There's no guarantee like that. Sometimes the last 10, 15 minutes could be the most important thing that I'm explaining or saying for the whole session. Can happen, right? So just a small thing I noticed. Right, I think you guys are done. You have let me know also. Yeah. So let's move on. Right. So I just want you to quickly check a few things here. So the common formula is for effective data protection, n minus a into b divided by 1 minus a. What is n? N is the nominal rate of tariff on imported final goods. I repeat, nominal rate of tariff on imported final goods. Final goods. Okay. Then what is A? A is a bit of an important or a new thing actually, which we need to calculate when we do a question. Percentage of imported intermediate goods, raw materials, included in the final product. This is not the percentage of tariff on the importer. That's the next point. This is as a percentage, what is the amount of imported inputs in the final product? We'll do the question, you will see what that means. Right? So percentage of imported inputs in the final product. Then B, nominal rate of tariff on the imported goods or the tariff on the raw materials. Final goods and the intermediate inputs. Right. This is printed and given in page 27. Let's put it to practice quickly. Same question. I have identified the points for you to make it easier. Okay. N in the formula is this, because N is nominal rate of tariff on the final good. B in the formula is this. Get it? Right. We need to do a small calculation to figure out the percentage of, or the A component. What is the A component? A is percentage of imported inputs or imported intermediate goods within the final product value. So what you do is for the 300 divided by final product value is 500 into 100. How much do we get here? Sorry. Actually, it's easy if we take it in fractional terms for the calculations. 60%. Yeah, very good. Very simple calculation, right? 60%. Because 20% is 100. 300 meaning 20 into 3, 60. 60%, nothing. Right, 60%. So 0.60 is the fraction we are looking for. Are we okay? So if we know that, it's a simple calculation. I've decided to do it there itself. Anyway, you guys can quickly do this with me. It's very straightforward. A small additional thing to know. Okay? Right. So apply the values. If you apply the values properly, n is 10%, 0.10 minus a into b. A is 0.60, b is 0.05. Divided by 1 minus 0.60. 1 minus 0.60. If you solve this properly, it will be 0.07 divided by 0.040. The answer should be 17.5 or 0.175. Are we clear? So in case you are not given the value addition information, still, in case you are not given the value addition information, still you have a method to estimate effective rate of protection. That's the advantage of this method. Is that clear? In a question, if they give you as long as you know the percentage of intermediate inputs within the important intermediate inputs within the final product, you can do this. As long as the information for A is given, you can do this. Get it? Right. Any questions, please? We're going to go to the final part, which is also, I think, important. I said this is one of the reasons why I want you to know this formula. If a government, I hope you guys are completing this and will let me know soon as you are done. Meanwhile, listen to what I'm saying, okay? If a government, right, okay? If a government wants to ensure it is providing the highest possible ERP, or has possible protection, effective protection to its domestic producers, there are three fundamental requirements they have to ensure. What are they? I will go to the study material because I have given it very clearly there. Even in your examiner's textbook, in one version of it, there's an error the way they have given this. It's wrong. Okay, so this I have used numbers and proven this for myself so that I can be confident with the points. So special note, okay, how to ensure the highest ERP. First thing you have to do is make sure the nominal rate of tariff on the final imported good is a high value. Okay. Nominal rate of tariff on the final imported good, that is the N component, make sure it's a high value. Secondly, nominal rate of tariff on imported inputs, intermediate inputs being a low value. Charge a low value on the imported inputs, that is B component. Thirdly, this is where many people get this mixed up actually. The percentage of imported inputs within the products, the final product should be, that is the A component should be a higher value. Many people say it should be a lower value. No, it should be a higher value. So if these three conditions are satisfied, then you will have a high ERP, high or rising ERP, high or rising ERP. Get it? Right, really good thing to know. Okay, so in terms of the study material, we have completed the third chapter, Protectionism. But there's a small thing I mentioned that I want to share with the slides. Okay. Right, market effect. Now with that, we'll assume there is a certain product that is being imported into Sri Lanka. So this is the domestic market. SD is the domestic supply. This is the domestic demand. Sri Lanka is a small country, or as a small economy, most of the things we import from the world market, we can import any quantity we want, but at the existing world market price. In other words, Sri Lanka is a price taker, not a price maker when we import. I repeat, Sri Lanka is a price taker, not a price maker when we import. Therefore, our import supply curve is perfectly elastic. Our SM, importer supply curve, is perfectly elastic, and it is parallel to the quantity axis at the existing world market price. At the existing world market price. In this case, it is P1. And at P1, demanders are willing to buy Q4 quantity. So we identify that as the equilibrium, E1. This is the domestic equilibrium, but it doesn't operate because the product is also being imported. If the product was only bought and sold domestically, then P is the equilibrium. Okay, right. Then domestic suppliers say at the price of P1, they are only willing to supply Q1. But the consumers want to buy, demanders want to buy Q4. So the difference between Q1 to Q4, I'll repeat, the difference between Q1 to Q4 is being imported. Is being imported. So the total supply curve has a very unique shape. The shape of the total supply curve, if someone wants to know the total product supply curve, it has an upward sloping part, the domestic supply. Okay. Then it has a parallel path like this. So the total supply curve is very unique. Okay, the general shape is this. This is the total supply curve. Total supply curve. Get it? Right. This is domestically supplied domestically. This is imported supply. That's how it's made up of. Okay? Right. Then government decides to charge a tariff. So as a tariff, you add the tariff to the price, which means the price increases, supply curve will shift upwards. It is not an increase in supply, it is a decrease in supply. So there is an upward shift. Right. Then, now the domestic producers earlier only got the price of P. Now they get P plus T. So they get a higher price. So their quantity they increase. They say, okay, we'll supply now not Q1, we'll supply up to Q2. Get it? Domestic supply increases a bit, but the imported supply decreases because the price has increased. Earlier we supplied from Q1 up to Q4. Now we supply only from Q2 up to Q3. Consumption has also reduced from Q4 to Q3. Right. If we analyze this a bit further, we can find 5 effects actually. So yeah, total supply curve before, total supply curve after. You can see how the changes are happening. Right? Okay, Putha, I'm just asking, only if possible, is there a way for you to capture this? I mean, not to draw this, but can all of you, are you savvy with your device to capture the screen? Can you do that? Now don't start doing this for everything, only for this slide and the other one maybe. Yeah. Can you do a screen capture? I think you guys like to call it a what shot. Yeah, take one of those, please. And make a screenshot. No? You all know stuff, no man. What is this? No, very tech savvy people. No? Okay. Then all of you can, right? Anyone who cannot, maybe you can help your friends also. Because otherwise, I will have to just for a few slides come up with a whole PDF and give it as a downloadable, and it's a headache. Okay. Then some of you might be asking, sir, why didn't you put this in the tute? Why didn't you include it in the tute? Good question. Answer is it's a bit of a special illustration that I do. Then I have developed after some work, after some research. So when I put certain things on the tube, it basically right? It's just out there. And the saddest part is people use all that, but never Sri Lankans are very bad at, quoting their source or giving credit or whatever. They will use it as if they came up with it, and then if possible, criticize it also. Right? So certain things I can only do this way. Done? Okay? Shall I move on, please? I'm waiting for a green light from you guys to go to the next green slide. Okay, yeah. Done? Right. We are 2 minutes past the deadline, but I don't know whether any of you closely observed the Zoom meeting timeline. Did you see something? Anyone? What does it say? While you check for that, I can move on, I guess. Screenshot is done. Screen capture is done. Right. Okay. No? No one is willing to look at it? Okay, right. Now, after I finish explaining this, you have to capture this screen also. Then I have the letters. Okay, right. But correct me if I'm wrong. I think I scheduled the session until 1:15. 1:15, 1:5. Okay, don't get a heart attack now. Done? Right. We have something called the price effect. Okay, 5 effects I said, right? First, price effect. Increase in price due to the tariff. How do we explain it? P to P1 plus T, sorry, P plus T, increase in price. Number 2, consumption effect. Earlier we used to consume from up to Q4, now we are only consuming up to Q3. So consumption decreases from Q4 to Q3, total consumption. Number 3, production effect. Earlier we produced Q1, now we are producing Q2, increase, production effect. Number 3, trade effect. Earlier the trade was Q1 to Q4, now Q2 to Q3, reduction. Reduction, Q1 to Q4, now Q2 to Q3, reduction. 1, 2, 3, 4. Price effect, consumption effect, production effect, trade effect. Final one, easiest ever. What is that? The tariff effect, net tariff effect. Okay, so the net tariff effect is calculated by taking change in consumer surplus, change in producer surplus, and the change introduced through the tax, basically. That is the amount of tax government will charge, government's tax revenue, the tax burden, one would say. Right. So shall we capture the areas? Look at the screen quickly. Consumer surplus, area below the demand curve up to Q4, price of P1 before the tariff. Now, consumer surplus is restricted to area below the demand curve up to Q3, price of P plus T. Now the consumer surplus is this area, big triangle, but lesser than the earlier. Earlier area was including ABCD. Now ABCD is not part of what surplus? Consumer surplus. Right. Then producer surplus. So what did the consumer lose? A, B, C, D. Increase or decrease? Decrease. Negative. Minus value. Get it? So minus value. Right. Then, okay, I'll bring that a bit later. Producer surplus. Producer surplus is the domestic supply. You can't do producer surplus with the imported supply curve, domestic supply. Area above the supply curve, earlier, Buddha, it was this tiny triangle up to P1. Now the producer surplus goes up to P plus T, up to Q2. So basically, producer surplus is now this bigger green color triangle, which includes a new area which was not there, A. So change in producer surplus is A increase, so plus value, positive value. Consumer surplus decrease, A, B, C, D negative, A plus because it's an increase in producer surplus, right? Government, what is the government's tax revenue or the tax burden here? We'll use a quick different color for that, right? Basically, per unit, the tax is the vertical distance, no? The difference between P plus T to P1. Per unit, this is the height. But the quantity imported, tax is on the imported good. Quantity imported is Q2 to Q3. I'll repeat. Quantity imported is Q2 to Q3. So this per unit tax, quantity of Q2 to Q3, you will agree tax incidence, the tax burden area is this. The blue color rectangular, the blue color rectangular, which is a revenue for the government, which is a plus value, which is a positive value, right? So what we end up with is this. Okay. So do you see what I see? What do you see? Minus A plus A gets cancelled off. Minus C plus C gets cancelled off. What is left? B and D negative values. They are the net tariff effect. Essentially, this is the DWL, dead weight loss. Dead weight loss. Get it? Right. So I want you guys to capture this screen or take a, what do you call it? A screen shot as well. Then we are done. Okay. So while you guys do that, I will stop the recording. And ladies and gentlemen, that's the end of the third chapter of Unit 9. Next week, we will be looking at the fourth and the final chapter of Unit 9. And hopefully, with the next class, I will finish Unit 9. And I'm hoping to, if possible, to get a small intro into Unit 10. Okay? Right.